is we're doing our 35th meeting of the Commodity Futures Agricultural Advisory Committee. And I want to sincerely thank all the members of the Advisory Committee for participating in this and also supplying us with the questions or the subject matter, because we polled you to ask you what's important, and you sent back and said these are the items that are important with us. The Ag Advisory Committee provides a forum for building a base of knowledge at the Commission on issues that matter to agricultural community. This is particularly important at a time like this when the Commission is tasked with writing dozens of regulations to implement the Dodd-Frank Act. The Commission is acutely aware of the far-reaching impact that these regulations may have, but we depend upon those who will be impacted by our rules to provide us with their thoughts and concerns in order to be certain that the Commission's regulations do not have unintended consequences. Now that the Commission has essentially finished the process of the proposed rules and has received many comments from the public, this is an ideal time to convene the committee to discuss some of the concerns that have been raised in comment letters. Hopefully, the Agricultural Advisory Committee also serves as an important role in making the Commission's work less opaque and more accessible to the various components of the trading industry and to the public at large. As I have stated on a number of occasions, the Commission's process for proposing regulations pursuant to Dodd-Frank have been more open than any that I've ever been involved with, and I commend Chairman Gensler for his leadership in this regard. It's my hope that today's meeting will provide the public with further information as to what the Commission is doing and why, and that we will have a meaningful dialogue regarding both the Commission's proposals and the Committee's concerns. Thank you to everyone who is in attendance, to my fellow commissioners, to Advisory Committee members and Commission staff, and the public. I especially want to thank the panelists today who each valued member of the Commission staff. As you all know, we have a full-time job overseeing commodity trading over the years, and we have the additional privilege of writing dozens of new regulations and implementing Dodd-Frank Act. Today we'll hear a presentation from the CFTC staff in 4 topic areas. This is based upon current events and things that have been ongoing with the Ag Advisory Committee and requests by the membership of the Agricultural Advisory Committees. First, an update on the agricultural commodity markets in general, focusing on the impacts of the recent floodings and issues of convergence. Second is a presentation on the Commission's proposed rule regarding position limits and hedge exemptions. Third is a presentation on the Commission's proposed rule regarding swap dealer definition and user exemption. And fourth, a presentation on the Commission's proposed rule regarding margin requirements. After each presentation, the Agricultural Advisory Committee members will have an opportunity to ask questions and discuss the issues raised in the presentation and the proposed rule. Again, I want to thank all of you for participating in this important meeting, and I'll ask my fellow commissioners if they have any opening statements.
Good morning. Thank you, Commissioner Dunn, for chairing today's meeting of the Agricultural Advisory Committee and for your leadership. And though there will be many opportunities to thank and congratulate Commissioner Dunn for his more than 6 years of service at the CFTC and 25 years of service at the federal government, I just want to take this opportunity. It'll probably be one of many. You'll be here a while, Mike. I want to take this opportunity to publicly acknowledge Commissioner Dunn. Mike is a trusted colleague for all of us and works incredibly hard in service to the American public and the CFTC. His significant and thoughtful contributions have strengthened all of our efforts at the Commission to promote transparency and lower risk in the derivatives markets, to protect the American public. I'm honored to have worked with Mike and to call Mike my friend. I also joined Commissioner Dunn in thanking my fellow commissioners and the expert panelists and staff who have joined us today. This Agriculture Advisory Committee has been a terrific source of input and advice as we've moved through our rulemaking, but even on our normal business. This meeting comes, of course, at a crucial time as we're rule writing with regard to implementing Dodd-Frank. And at this point, we have substantially completed, as Mike said, the proposal phase of our rulemaking. And since the President signed the Act last July, the Commission has promulgated rules covering all the areas of the Act for swap regulation with the exception of the Volcker rule. And we do have a testing and supervision rule we will be putting out. With the substantial completion of the proposal phase of the rulemaking, the public now has the entire mosaic, and it will allow you all to give sort of a comments with all these rules and how they interplay. I'm particularly interested in the views of this panel on the entire mosaic. I know that we're going to be chatting about a couple of topics, but particularly how it implicates the agricultural derivatives markets. There are two specific topics that are just agricultural focused, like the definition of agricultural commodities and also how we treat agricultural swaps, but there are other important rulemakings that are much broader and have implications for the agricultural markets, some of which we'll be talking about, like the position limits and hedge exemptions, the swap dealer definition. I would put in also the forward exemption as it was put in the product definition area. The end-user exception, I know, is going to be discussed in the margin requirements for uncleared swaps. Again, I'd like to thank Commissioner Dunn and my fellow commissioners, as well as this committee members, and I look forward to today's full discussion.
Thank you, Mr. Chairman. Commissioner Summers.
Thank you, Commissioner Dunn. Good morning. As I think most all of you know, Commissioner Dunn's term expires in June, and the White House has nominated his replacement. So today, at this Agriculture Advisory Committee meeting, whether or not he ends up chairing another one or not, I feel that it's appropriate to echo the chairman's thanks to Commissioner Dunn for his leadership, especially on the issues important to the agricultural community and for this advisory committee. I seek his advice on many issues, but certainly these issues particularly, I will miss his advice and counsel. I think that the group and the groups represented around this table are the groups that have traditionally been the ones advising the CFTC on issues since the creation of this commission. And while we are writing new rules, implementing Dodd-Frank, and taking over responsibility for an entire new marketplace, we have many people that come in to speak to us every day that tell us they've never been to the CFTC, they don't know much about how we function, but they have a number of issues with the proposals that we've done over the past 9 months. I am particularly heartened today to see that some of the most important issues that we are tackling in implementing Dodd-Frank are on the agenda today, and we're getting the advice from our traditional constituency about how these proposals will affect you and your businesses. So thank you, Commissioner Dunn, for a great agenda, and I really look forward to hearing from all of the panelists around the room, and want to say again thank you to Commissioner Dunn for his leadership.
Thank you, Commissioner Summers. Commissioner Chilton.
Thanks, Mr. Chairman. I'll be brief, but also echo my colleagues' thanks to you. You've done a great job at all of these Ag Advisory Committee meetings, Mike, and your staff has done great. They're always well put together. Jason, Nicole, and Bob did a great job on this one, too, and thank you for doing it. I know it's often a thankless chore. A couple of years ago, April 22nd of 2008, we had one of these. And it was right when prices started to become somewhat disconnected from supply and demand, April 22nd, 2008. And it was shortly after that a lot of members of Congress raised concerns about excessive speculation. As we recall, in July, Senator Reid offered a bill to deal with excessive speculation, defeated on a cloture motion. Later that year, the House actually passed a bill with bipartisan support to deal with excessive speculation. Here we are again in 2009. Congress passed Dodd-Frank, told us that we needed to put these limits in place. And that's sort of a drastic measure. We had the ability to put limits in place back in 2008. There's a Miranda Lambert song, a country song now, that talks about taking sort of drastic measures. And I view it as sort of a drastic measure when Congress has to tell the regulators, you will do something. And I'm a little concerned that I'm very concerned that we haven't put position limits in place. I'm a little concerned that some in Congress, and we've received letters in the last couple of weeks, maybe over 100 congressmen and senators telling us to implement position limits now. I'm a little concerned that we'll also be faced with a drastic measure of Congress telling us specifically how to implement position limits. It won't have all the bells and whistles on it if we get told how to do it in statute. It won't have sort of the texture and granular nature that I think we need on any rule that's so important. So I really hope that we go forward. I've talked about it again and again, and I know I'm like a broken record, particularly to my colleagues on this, but we could do spot month position limits right now. We have them in the ags. We need them in metals. We need them in energy. And I'm just continually get concerned that as we're trying to be deliberative, which I appreciate, we're also not moving fast enough on putting them in place when Congress gave us this deadline. So I think we need to get her done, and I'm also interested in listening to the committee members tell us about the ag legacy limits, if they should stay the same, if they should change. And I know this isn't on the agenda, and we're not going to probably have enough time to get to it. But I've been contacted by a lot in the ag community, and a couple this week, raising some concerns about something that a lot of us has talked about, particularly Commissioner O'Malley, and that's the cheetah traders, the high-frequency traders, and their impact on markets. And there's an open book on where we are on these things, but people continue to raise concerns about they're having an inordinate impact at times, at certain times in markets. So if people have thoughts on that, I'd appreciate it also. But thank you very much, Commissioner Dunn. Again, appreciate all your work.
Thank you, Commissioner Chilton. Commissioner O'Malley.
Let me be the last word on the Commission, at least, to echo my thanks and appreciation for Chairman of this subcommittee and Commissioner Dunn's hard work and leadership. He is my hallmate just down the hall, and I rely on his counsel frequently, especially on these issues and other issues regarding the Commission. So I can't express how much I appreciate your support, your guidance, and your counsel working here, and your years of service to this nation, we should all be grateful. I'd like to thank you for hosting today's meeting of the Agriculture Advisory Committee. I look forward to the staff presentations and a healthy discussion on each of the areas that you recommended, and I appreciate the Chairman's desire to just open this up for what the Ag Advisory Committee would like to talk about. I don't ever think it's a bad idea to take the time and stop and reassess where we're going in order to make sure we're still moving in the right direction, especially if we don't have a roadmap. A few weeks ago, the CFTC and the SEC held a joint staff roundtable to discuss the implementation process. We heard from all of the members and participants very thoughtful comments, and it was abundantly clear to me that all the market participants are ready and willing to comply with the rules, but their capacity to do so depends largely on the Commission's sharing its implementation strategy. I heard the same message over and over again at this roundtable. Market participants need an implementation strategy to make necessary investments, hiring decisions, and reorganizations within their companies to comply with the rules. Despite the roundtable, the Commission is yet to commit to drafting a comprehensive schedule for sequencing of final rulemakings or an implementation plan. I think it's time we answered the call and let everyone know what we intend to do and how we intend to do it. I will continue to recommend the Commission release a comprehensive schedule on the sequencing of the final rulemaking and a proposed implementation plan in the Federal Register. After we receive public comment, then we should release a final schedule to the public. I believe this small effort on the Commission's part will bring transparency to the rulemaking process. I would also like to take this opportunity to request of the full Commission Chairman to hold a staff roundtable to discuss the swap dealer proposal. I have publicly stated that I believe the definition is too broad and the exceptions are too narrow. The commitment letters seem to support this as well. I appreciate our recent effort to tackle individual seg, actually for the second time. Complicated issue. My compliments to the Chairman for taking the opportunity in our pause to have that meeting. And next week? So
I think it's June 3rd.
June 3rd. Another great opportunity to to get participants to discuss the ramifications of these rules, and I greatly appreciate that. The swap dealer rulemaking is an extremely important rulemaking as it relates to who is and who is not subject to capital and margin rules, which we'll discuss here, among others. I believe that a roundtable is necessary to hear from the public and those entities that believe they will be subject to regulation under the new dealer rule. Now, Chairman Dunn, a year and a half ago, I attended my first Agriculture Advisory Committee meeting. It was my second or third week on the job, my first public appearances, and I was terrified because we were taking on the easy topic of the convergence in the wheat contract, which I had very little knowledge of at the time. I was impressed by the body of work that this committee produced to uncover the fundamental flaws in the wheat contract and offered a range of options. Again, I'm pleased to have you chosen to focus on the needs of the agriculture community, a group that truly embodies end users and who pose the least amount of systemic risk, but could pay a very high price as a result of the proposed reforms mandated under Dodd-Frank. I appreciate your willingness to organize this forum and to discuss these important topics, and I look forward to our presentations from staff and the discussion of the members. Thank you again.
Thank you, Commissioner O'Malley, for all the kind words I've gotten on my advice and counsel. Let me remind everyone, I get that back fourfold, so I appreciate my fellow commissioners. If I could get the advisory committee to introduce themselves and who they represent, and Kevin, if I could start with you, please.
Kevin Natz with the National Council of Farmer Cooperatives.
Doug Somke with National Farmers Union.
Todd Kemp with the National Grain and Feed Association, and I'm sitting in this morning for Matt Bruns, who's our regular contributor to the Ag Advisory Committee.
Edgar Hicks, Nebraska Grange. National Grange, I represent Nebraska.
Roger Crine with the National Milk Producers Federation.
Neil Dirks on the National Pork Producers Council staff.
Bob Deneen with the Renewable Fuels Association.
Fred Clark on behalf of the U.S. Rice Producers Association.
Reese
Langley, USA Rice Federation.
Robbie Boone, Farm Credit Council.
Dana Peterson, National Association of Wheat Growers.
Mark Scanlon, the Independent Community Bankers of America.
Christine Cochran with the Commodity Markets Council, but Jason Unger will be representing us once he arrives.
I'm Jordan Lee. I'm representing the American Cotton Shippers.
Diana Preston with the American Bankers Association.
Hayden Wands with the American Bakers Association.
Well, thank you very much. Let me introduce a couple of folks that are here in our audience representing Ranking Member Colin Peterson from the House Agricultural Committee, Sharon Josephson. If you would stand up, please. And from the Senate Agricultural Committee, Russ Vaham. Am I saying that right, Russ? Yeah. Thank you. Who is a new legislative fellow on the Senate Agricultural Committee. So everybody keep your eye on him and Sharon as well. Is there anybody else here from the Hill that I missed? We also have representatives from the various exchanges, and if they'd like to rise and identify themselves. David, if I could start with you. Anyone else from exchanges here? Very fine. Let's then begin with our first panel. This is kind of an overview that we're going to be getting on what's going on and a little tie-up of some of the past business we've had on convergence. And if I can please get Dave Amato, who is the Director of Agricultural Contracts Market Surveillance Branch. Please give your presentation, David.
Thank you, Commissioner Dunn. As Commissioner Dunn just mentioned, I've been asked to talk about current ag issues. We're going to talk a little bit about prices, a little bit about the flood, and finally convergence. I'd like to thank the AAC for this opportunity to speak to you, and just to reiterate what everyone has said about Commissioner Dunn, thank you for all you've done. You've been a great advocate for the ag community, and especially on the convergence issue. I think a lot of headway was made because of your effort, so it's much appreciated. To begin, this first chart is, I'll look at mostly the grains, and we also have cotton on this chart. Basically, nearby prices are strong across the board for all these different commodities. However, besides cotton and corn, which have had recent record highs hit, we're very far away from the levels that we saw in 2008. However, there's a lot of fundamentals at play, a lot of weather issues, the flood issue. There's a lot of impact on the market coming up, especially this summer, that could have a big impact on prices, and most of the fundamentals are bullish right now. We also have this very low interest rate environment and a weak dollar, which many economists will say will have an impact on commodity prices. Just to highlight the corn, which has hit a nearby high back in April 11th, we're looking at 15-year lows for the ending stocks. Stocks-to-use ratio is also at a 15-year low. The ending stocks translate to about a 20-day supply of old crop corn when we start the new crop year for the 2011-12 year. Cotton, also very similar type of fundamentals. We have the lowest ending stock since 1960. India, the second largest producer, has put a restriction on exports of cotton. And China, the largest producer, importer, and textile manufacturer in the world, is forecast to import about 40% more cotton than last year, and it's expected about half of that to come from the United States. So we're not anywhere near where we've been in 2008 in terms of the ag community in general, but we definitely have bullish fundamentals, and with some of the weather and flood situations, things could definitely get even more bullish. Taking a look at the next graphic, this is a look at corn historic volatility. This is only historic volatility in the month of April. And the historic volatility is a measure of how much prices have changed during the month. It's computed as an annualized standard deviation of the percentage change in daily price. April, actually, if you look at all the months, April is below the mean volatility of all the months. July, if we had put that up, would be the most volatile, and that seems very intuitive because of it's a summer weather month, and it's a big importance in terms of the growing season. There's been a general upswing in volatility over time, while at the same time we've seen absolute price levels rise considerably. This graph goes all the way back to the 80s. Obviously, in the 80s and 90s, early 90s, we had prices in the $2, $2.50 range, and if we go all the way up to recent times today, you're seeing prices close to almost $8. So prices have risen considerably, and also price limits have been raised considerably over time. In the 90s, we had 10-cent limits. That was raised to 12 cents. Then in 2002, we raised it to 20, or I should say the Board of Trade raised it to 20 cents, and then 30 cents in 2008. I think one final little piece of information on this graph. I took a look at the daily price moves from 2007 to 2011, and for the April corn contract, and we had an average daily move about 8.25 cents. So obviously, that is, when you look back at where the price limits were back in the 90s, a 10-cent limit, to have an 8-cent move on average every day just shows you how volatile the corn market has been. And that volatility has corresponded with years where we've had bullish fundamentals and high prices. The next graphic takes a look at some of the planting progress and the conditions. Obviously, we've had a tremendous amount of precipitation this spring, especially in the eastern Corn Belt. And we've also had very, very cool weather. I'm from Chicago, and we had absolutely no spring. It's basically been like November for the entire spring. So that's going to have a big impact on the corn crop. If you look at the 63% for the completed progress, that doesn't look so bad next to the 5-year average of 75%. But I broke it out there, and you can see the eastern Corn Belt is only at 35% complete, where the western Corn Belt is at 85%. So we have sort of a dichotomy in the Corn Belt there. And the other thing I wanted to highlight is the winter wheat. We have very, very poor conditions. The poor to fair conditions is at 45%. The 5-year average is only 8%. So that does not bode well in terms of a quality crop, and that's going to be very bullish going forward. We already said that April was extremely volatile in 2011. With the slow planting, and if we get any weather scares, and we always get weather scares during the growing season, we could see much more volatility going forward. This next graphic is the Mississippi watershed. This view will show you the rivers that flow into the Mississippi. I drew in the red to show you where we have the flood. Obviously, the biggest impact is going to be the Mississippi River down towards the Gulf, where most of the exports are shipped out. The causes for the flood is we've had high levels of snow cover in the upper Midwest. That led to a high snow melt and a runoff. In April, like I said, the rainfall in the northern tier of the Corn Belt and the Great Plains combined with that snow melt. So we have the combination of rain and snow melt to the tributaries of the Ohio, Missouri, upper Mississippi rivers. That led to a surge at Cairo, Illinois. And that Cairo, Illinois is right where that Bird's Point levee is on the map there. Between May 2nd and 6th, the Army Corps of Engineers destroyed the levee at Bird's Point. This was an attempt to prevent the flooding of Cairo. This is only the second time that the floodway has ever been opened. On May 9th, the Army Corps of Engineers opened the Bonnet-Carré spillway to release water from the Mississippi River. This is going to allow water to reach the Gulf of Mexico. And on May 14th, the Army Corps of Engineers opened the Morganza spillway north of Baton Rouge to allow potentially about 3 million acres in the Atchafalaya River Basin to flood. This is the first time in the history of the country that all three of these flood control devices have been used together. So obviously we're in a very, very serious situation. Taking a look at some of the agricultural impact of this flood, again, this is very, very preliminary. I have a feeling that these numbers will change and probably get worse in a lot of cases. You also have the human element, people's homes being flooded, possible loss of life, and things like that. But this is just focusing on some of the initial agricultural impacts of the flood. Barges are not allowed to move south of Natchez, Mississippi, and no grain vessel loading for a while. Obviously, this could cost tens of millions of dollars per day, so that could have a huge economic impact on the country. The different farm bureaus are estimating 2 million acres of land in Arkansas, Tennessee, and Mississippi are flooded or under flood threat. In rice in Arkansas, there's projections that nearly 300,000 acres, or about 21% of the Arkansas planted acres, could be lost. That would be about 10% of total U.S. rice acres. Between Arkansas, Louisiana, and Missouri, there's a potential 40% reduction from last year's planted rice acreage. We see similar things happening in winter wheat in Arkansas, where about 120,000 of 550,000 projected planted acres will be abandoned. That's a loss of millions and millions of dollars. Cotton, again, preliminary numbers say 66 million. That's expected to get a lot bigger. And finally, with the closing of barges not being allowed to pass Natchez, we're seeing basically the export market being greatly, greatly reduced. So this is going to have a big impact going forward. To take it and look at how that's affecting actual futures contracts, this is a special bulletin that was put out by the CME that talks about these sorts of acts of God kind of situations and the contingency plans that are made. Basically, with the flooding that's taken place, loadouts are definitely affected on the Ohio River and in the St. Louis area. And so different commercial firms have had to look and negotiate different alternatives besides the normal planned loadout that was expected to take place. So, again, not only is it affecting things way down the Mississippi River and affecting exports, it's also having an impact on our futures contracts directly as well. The final topic I'd like to talk about is the convergence issue. Both Chicago soft red winter, Kansas City hard red winter, and the Chicago Board of Trade rough rice contracts have had convergence problems. The standard to which the CFTC holds the exchanges is to see the cash and futures prices come together at the par points upon or near contract expiration. Convergence is core to the mission of the CFTC, and it goes to the heart of public confidence in price discovery and risk management functions of futures markets. The problems have been more protracted in the soft red winter wheat market, but in both wheat cases we've seen the basis deteriorate as the calendar spreads approach financial full carry. In this scenario, it's advantageous to hold a delivery instrument from one contract expiration to the next, earning a small return on the spread. Loadouts are extremely unlikely to occur when futures is above cash. Elevators are hesitant to issue more shipping certificates or warehouse receipts in these full carry markets, as they know the grain will not move for months and the commercial firm will lose control of a portion of their elevator space. At this point, the arbitrage link between cash and futures appears to be broken. Why is this an important issue? There's several side effects that happen when you have poor convergence. The main one, futures markets are supposed to, at their essence, be a price discovery mechanism. When you have futures prices that are 80, 100, or even 150 cents over the cash market at par points like we've seen in the past at Kansas City on the Kansas City Board of Trade or at Toledo on the CBOT, price discovery is obviously very weak. We look to the futures for price discovery, but at times the futures price at both exchanges had seemed to be decoupled from the physical cash market. The second point is the hedge effectiveness. Hedge effectiveness is hampered when the basis loses its predictability and producers are dealing with a very volatile basis. It becomes much more difficult for them to hedge. The third point, which is a very big deal, obviously, to market surveillance at the CFTC, is the potential for market manipulation. When you have contracts that are not performing or not sending out the right price signals, it can lead to actions that can appear economic, and that puts the market surveillance staff in situations where their investigations have to take place. The fourth point would be the forward contracting. A volatile basis and poor convergence makes some elevators not willing to forward contract. We did several interviews in Kansas back in July of last year and talked to some banks and different credit agencies, and that ties into the fifth point, an agricultural lending crunch. The volatile basis has forced some banks to lend less and or require more collateral. And finally, something that the USDA deals with is the crop insurance program. When you have the USDA using futures prices to calculate estimated producer revenue, and futures are well above cash, it's a overstatement of the projected revenue that a farmer is actually going to be receiving. So again, that makes that program much less effective. In short, this is a huge issue for the ag community, and that's why the CFTC has invested so much time and effort to address the problem. And what has been done to address the problem is the following slide. Over a 2.5-year period, the CFTC has worked with the CBOT through the Ag Advisory Committee and its subcommittee on convergence. And the CFTC has approved the following changes. In July of 2009, we saw an expansion of the delivery territory, quality specifications, and a harvest premium storage rate. In July of 2010, we saw the variable storage mechanism for the CBOT take effect. And basically what the VSR does is it triggers a higher storage rate when the spread between the near and next to expire contract is greater than 80% of financial full carry. It also triggers a decrease in storage costs when the spread is less than 50%. Currently, the storage rate is 20 cents per bushel. Kansas City also has had contract changes proposed, and they will go into effect in September of this year. The CFTC also worked extensively with the Kansas City Board of Trade and their wheat contract committee last summer There was work being done with the Ag Advisory Committee. There were numerous staff visits by market surveillance working with the exchanges, and there were also several commissioner visits from the CFTC and even a chairman visit back in July of 2010. As I said, the KCBOT has submitted these contract changes, which include increasing the base storage rate 30% to 6 cents, instituting a harvest premium storage rate of 9 cents, requiring monthly payment of storage, establishing a par protein level of 11%, and tightening the specifications on vomitoxin. While these changes represent a significant increase in the storage rates and will likely result in an improvement in cash futures convergence, the CFTC will continue to monitor the situation carefully to discern whether additional changes are necessary. It's obviously much too early to judge what kind of impact this will have, but I think these moves should have an impact and should help to improve the contract. And finally, the rice contract, which hasn't gotten as much attention as the 2 wheats, but we see a contract change being instituted in September. Currently, the discounts and premiums are based off of futures prices. With the rule change, those discounts and premiums will be based off of a USDA 5-year loan rate. This rule change should help to remove some of the uncertainty of delivery values of rice and, in effect, help the contract. The CFTC continues to monitor the basis levels and convergence, particularly with respect to the calendar spreads, carrying charges, changes to world supply and demand, changes in absolute and relative levels of participation by the different market segments, whether they be commercials, index funds, or managed money. I'd like to reiterate that although the CFTC was assertive in drawing attention to the convergence issue and the need for action, the CFTC did not create or recommend the contract remedy for either exchange. The VSR was designed within the CME Product Research Department, and the KCBOT changes were devised by their wheat contract committee. The following graphs give a little bit more detail of what we've been looking at and monitoring over time. What this graph is the Chicago Board of Trade soft red winter wheat contract. The left side of the y-axis in blue is the basis on first delivery day in cents per bushel. The right side of the y-axis in red is the percentage of full carry. As I mentioned before, in general, as the percentage of full carry goes above 80%, and especially as it approaches 100% of full carry, we tend to have a weak basis. In these full carry markets, some shorts deliver as futures is above cash, so the futures market is the short's best sale. Under non-full carry scenarios, these deliveries would cause downward pressure on futures prices. However, in full carry markets, the longs are perfectly willing to take the deliveries as their costs are being covered and oftentimes a guaranteed profit as well. In these instances, the long is looking at the wheat futures market like a financial instrument instead of just grain. The long can earn 2 to 3% guaranteed return, much better than a short-term treasury, and have all of their costs covered. And in the case of a market disruption, they have what amounts to a free call on the grain. This graph shows that between May of 2008 and May of 2010, the CBOT wheat contract experienced very poor convergence on a week basis. The basis from July 2010 through the May 2011 contract has showed marketed improvement, and we've had good to decent convergence in 4 of the 5 expirations. And that's since the VSR has gone into effect. September, obviously, you can see September of 2010 is the outlier there. The reason why we tend to have bad convergence in the September contracts, and that's the case going back through history, at that time, with the corn crop coming online, a lot of elevators drastically drop their bids or make very, very low bids for wheat, and we often see the September being the worst month for convergence. We believe that the VSR has helped convergence, but we also had a 40% smaller soft red winter wheat crop from the 2009 to 2010. So with a much smaller crop, it's hard to say how much of the impact is the VSR, but we have seen an improvement in the basis. Going forward, we're going to obviously need more crop years to fully judge the effectiveness of this VSR. The contracts at both Chicago and Kansas City have tended to converge when we've had either tight markets or more normal supply and demand. The problems have come when we've had these situations of oversupply. Oversupply has led to these convergence problems. An effective contract should be able to work no matter what the fundamentals are, whether we have a tight market or if we have a very large supply. The Kansas City situation is very, very similar, and this setup on the graph is exactly the same. The left axis is the basis on first delivery day. The red is the percentage of full carry. In general, like I said, as we go above 80% and approach 100%, we have the weak basis. The last 9 expirations at Kansas City have had very, very weak basis and poor convergence. The May that went off the board just recently on the 14th went off at 75 under on first delivery day. The Kansas City rule changes to improve convergence go into effect with the September contract. There's a lot of confidence that will help, but obviously we haven't seen the contract's changes go into effect, so we're going to need time to evaluate that. It's much too soon to judge. And then the final graph that I have is the same concept, taking a look at rough rice. Rough rice is a lot more difficult to really get a handle on convergence because cash prices are much harder to come by. It's a much more thin market. It's not liquid the way we see the wheats and the corns and the soybeans. However, the same general concept we're seeing, especially over the last year, where we've seen very, very poor convergence. You can see at several of those expirations in the last year or so, we've had basis levels $3 under or $4 under, and the current May contract that went off the board on the 14th went off the board $3.50 under the future. Currently, we have a very large, poor quality crop, and again, as I said, that's what we have observed pretty much across the board of all the grain contracts. When you have large supplies, we've tended to have the poor convergence. It's our hope to have contracts that can work no matter what the supply and demand situation is. Next year's crop is expected to be much smaller due to the flood. The USDA is already showing an expected 17% decrease in plantings. With the flood, that's probably going to be much, much worse. So we should have a tighter crop situation, and the convergence problem will probably go away, but that's only because of the fundamentals change, not necessarily because of any contract change. The CFTC has been conducting trader interviews with the rice industry in coordination with market surveillance and product review as a preliminary first step to address the convergence issue. Overall, the work of the AAC and its convergence subcommittee have had a positive impact on convergence. And I think going forward, especially for the wheats, I think we're going to see continued improvement. And that's all I have. Thank you.
Thank you, David. David is one of the 3 Davids that I use out of the Chicago office. I call them the Daves, and they have just been invaluable to me during my tenure here. So I appreciate this briefing, but all the work that you've done in the past. I also want to thank you for giving us a quick overview of what's going on in the agricultural sector, but more importantly, that very succinct briefing here of convergence and why it is important to us as we see it in the marketplace. And I also want to thank the Agricultural Advisory Committee for working with the Commission and working with the exchanges and coming up to these fixes on convergence. It has been an effort where I have seen the industry as a whole dig in and work together. Although they have some conflicting views on these things, they've done a very, very good job, and the exchanges have been very open to their suggestions. With that, I will open it up to the Ag Advisory Committee for any comments or questions to David on his briefing. Commissioners? David, you've done your job well.
I'm just struck nobody's asking about convergence. I just want to associate myself. I think your comments on page 8 and 9 really go to the heart of why convergence matters. It's really to the confidence as to whether hedgers can use the product futures and have the confidence that it's an open, transparent market that prices their product, and if they wish to, they could deliver into the contract if there's this wide lack of convergence. So, good work, Dave.
Thank you.
I think there's still more work to do on some of the products to get to convergence.
Yes.
Thank you.
Mr. Chairman.
Let's then get panel number 2 in place. Steve Sherrod, who is the acting director of our market surveillance, and David Van Wagner, who is chief counsel of the
I think Ananda's signaling. There might be
Sorry, I thought I heard Commissioner Chilton. Anyone to say something?
Yeah, actually, and thank you, Ananda, and since you're still there, Dave, I was struck by this chart on corn historical volatility in April. It looks, of 30 years, we had the third highest volatility. And I'm curious, two things. One, Dave, is if we looked at that for, wheat and beans and rice, would it look similar? That's the first part of the question. And the second thing is, and I want to make sure I don't put words in your mouth, but what I thought you said in there in the middle was that the longs, and these are folks that have been called massive passives, that they were looking at wheat like a financial instrument, and maybe this is what people call the financialization of commodities. And so my question is, one, would it look the same for rice, wheat, and beans, this volatility chart? And two, do you think this financialization of commodities that you were talking about correlates with any of this in the more recent times, the 2007 and this year, 2011? And I'll just listen there. Thank you very much. Thank you again, Nanda.
I would say I can't speak to rice because I have not looked at rice, but soybeans would look similar. It has a similar crop year. For wheat, it may not be April, but the general trend is for the grains that we have had increased volatility. There's no doubt. And I would imagine rice would be similar, but like I said, I have not directly looked at rice. When I was talking about the financial sort of aspect of the wheat as opposed to people thinking of it as grain, I was talking about people who decide to take delivery. So that could be longs of any stripe. It doesn't have to necessarily be what we would define as sort of the index traders. And in fact, those index traders tend to roll, and that's public knowledge, they tend to roll before we get into the delivery period. So these would be either commercials or it could be a speculator taking advantage of this full carry situation. So I hope that answers your question.
Yeah, thank you, Dave. Appreciate it. Thanks for your indulgence, Commissioner Dunn.
Sure, thank you.
Commissioner Dunn?
Sure.
I think part of the reason why we haven't had many comments is this issue of convergence goes to the heart of all the issues that we have to address. Volatility. And coming from Nebraska and Kansas, my farmers were somewhat losing confidence in the system, I guess. And so if we can't solve the issue of convergence, how are we going to address the issues of the margin requirements and volatility? Because my farmers are starting to think that this tool is becoming a speculative vehicle. And so, I don't have the answer, but it just feels like I feel less of the ability of the advisory committee to be of service less this time than I did when I first came last year. So we can't give up, but it really is a struggle. And what I'm really worried about is that as our bankers in rural communities challenge our farmers when we most need the use of the futures market. And so it's kind of hard to have a comment. I appreciate the work you put in it, but how do we address the problem, I guess?
Well, Edgar, I think you've kind of hit the nail on the head, and for you, Edgar represents the National Grange, but he's located in the Omaha area. is it Omaha or Lincoln? Omaha. But we've seen a shift because originally the concern was on the Kansas City Board of Trade wheat contract where we first had the convergence problems. And certainly what David highlighted here of why it matters to us are the types of things that you're seeing. And now we have had a similar problem in the Kansas City Board of Trade with their wheat contract, and it really has hit home more for producers in your particular area right now. And I can understand that they've probably been a lot more vocal to you than they would when it was on the Chicago contract. But I feel that what this committee has done, what the exchanges have done, and being open, and frankly, the commission as a whole. I know I've used this as a bully pulpit, my position, as have other commissioners, and I feel that there is genuine support out there to address this problem and get it correct. And this is an ongoing, continuing thing long after I'm gone as chair of the Ag Advisory Committee. There will be people following up to see whether or not we have found the right solution. And I think it's incumbent upon all of you that are going to still be members long after I'm gone to hold our feet to the fire. The one thing that Dave said in his presentation is these aren't our contracts. They belong to the exchanges. But the exchanges are aware that that you are the customer base out there. And you have the ultimate control of whether or not you're ever going to trade those particular contracts. And you want to have them have the convergence so that it can be utilized for price discovery and risk mitigation. So I appreciate your comments, and I think they're right spot on.
Mr. Commissioner? Oh, go ahead.
This is me. Commissioner Dunn, I also want to thank you for your service. You've been invaluable to the agriculture sector in your sensitivity to our issues in this job and in your previous jobs. On this convergence issue, I think it's important to recognize that the Dodd-Frank regulations and requirements put the convergence issue in a whole new light. Under the status quo, the exchange can do what it wants, and as long as it's not egregious, you say go ahead. If we have new regulations that require clearing of all types of a very broad category of transactions, there's going to be a limited number of exchanges and clearing organizations set up to do these things, and a lot of actors are going to be forced into these transactions with these exchanges that you regulate, and all of a sudden allowing second best solutions is no longer acceptable. It's going to be much more your responsibility to define as nearly perfect a solution as you can find in cooperation with the exchanges, and the public and the users become much more significant stakeholders in the actions of the exchange. The flip side of that is, of course, gets into issues of exemptions for end users, and I've talked about this quite a bit. That I think that's the next topic. There has to be a balance. We can't have our cake and eat it too. We can't say the exchanges can do it however they want and then force everybody to use the exchanges. The alternative is to elect the exchanges to do things the way they want to do them, but leave people an out. And I think that's very important. Thank you.
Thank you, Roger.
One quick comment, and it ties back into what Edgar was talking about in terms of lenders' reactions and impacts on producers. Our industry has been concerned about a credit crunch coming again as commodity values stay high, perhaps even go a little bit higher. There is at some point a limit on what agribusiness lenders can provide to their customers to buy the crop to meet margin calls. There are rulemakings underway both in terms of Dodd-Frank implementation, and another good example is the daily price limit proposal for CBOT corn. We would sure urge the Commission to look carefully at those issues in light of the agricultural credit situation and in light of both points D and E up on the screen are really related. If it gets to the point where elevators are faced with much higher margin calls, much higher financial demands, at some point that eats into their working capital, and at some point it will affect their ability to forward contract with producers. That would have the effect of reducing marketing opportunities for producers, which is not good certainly for them, for our industry, or for U.S. agriculture. So we appreciate the recognition of those facts and encourage the Commission and this committee to keep it in mind.
Commissioner.
Thank you, Todd.
Commissioner Dunn, the ABA also appreciates the comments that Mr. Kemp has stated. The financial margin calls on the bakers have been moving financial assets away from our core businesses to something that we have very little control over. And so we want to echo the comments on the Commission to take very serious considerations on volatility. And Chairman Chilton, to answer your question, the ABA did a study on volatility in the Chicago Board of Trade wheat on a monthly average, and in 2005, January in 2005, the monthly volatility was 22%, and in January of 2011, the monthly volatility was 45%. So it echoed the same as in the corn market. So,
Mr. Commissioner, thank you again on behalf of the cotton industry for all your help and service and having worked with us at our conventions and all. And sort of along the lines of what Edgar and Todd were saying, I am actually a cotton merchant, and if David could chart it, there'd probably be no way the volatility and convergence, the two quickly divorce themselves. We've been at about 175% of volatility, or average volatility in cotton over the last year. And as we move towards new crop and out of a demand-driven cycle, we're quickly seeing the market become less dependable. And a little bit like Edgar said, the producers don't know what to say. And as a merchant, my tagline is, well, it doesn't matter. Here's your cash price. It's still a profitable cash price. But unfortunately, from a basis standpoint, it doesn't illustrate convergence. It probably illustrates the opposite of convergence. And as an example of what was just said, last year for me to hedge 1,000 bales of cotton was $7,500, an initial margin with no maintenance margin required. This year, it's a total of $100,000 just for 1,000 bales. And so if we're looking at potentially a 20 million bale crop of cotton, you can imagine the capital requirements and what happens. And you heard David mention what a dramatically tight supply situation we're in with ending stocks relative to cotton, and the lack of a dependable marketplace, sort of like what Edgar was talking about. The more it's seen as a speculative tool, or there's the lack of convergence, is just going to further discourage production, regardless of where the market price is, because the two become less and less closely associated.
Thank you, Jordan.
Mr. Chairman, thank you again for your service and all that you've done for the wheat industry, and thanks again to the staff for being so helpful in this convergence issue. Over the last year and a half since I came to the National Association, there's been a lot of discussion amongst our growers about what should our expectations be in this new market environment. With the convergence issues, with the higher prices, everything is uncertain for growers. And I think my question to you, David, is when you were talking about the changes to the contracts and it's too short of a time to really tell whether they've worked, what is an adequate amount of time to determine whether they've worked, and when do we start looking at the next level of surveillance?
I would say, like for the Chicago Board of Trade, those major changes went into effect last July, so we're almost at a year. Unfortunately, like I mentioned in the presentation, we had a dramatic reduction in the soft red crop. And as I've said, these contracts have worked when we've had small supply. So I would argue that it's you can't really judge the VSR. We have improved. Is that the VSR or is that a smaller crop? It's probably a little bit of both. I think you have to have a more normal supply and demand year, an average-ish kind of year, and then we can see if this contract is actually improved. So I think that's the fairest way to judge it.
I think we're all looking for a normal year.
Yes.
Dana, I agree with you. I just don't know what normal is anymore. That's unfortunately. But with the problem you raise is a legitimate problem and something that we've talked about all along on convergence, is that you can't just flip the light switch and say, we're making a change in this particular contract because there are people out there that have financial interests in those contracts. And again, I want to say that the exchanges have been very willing to come to the table and to offer proposals to us. And some of the proposals that were offered earlier on, for instance, with the Kansas City Board of Trade, they listened to the folks here, they went back, and they adjusted that. The same thing happened with the Kansas City Board of Trade. They made an adjustment, and we looked at that through a year's cycle, and then we determined that really didn't fix it, so they came back with another fix. And it's incumbent upon us to continue to stay on top of this so that your constituents out there can look to the futures market for price discovery and risk mitigation. And it's not going to be an easy job. There are more and more externalities that are going into there. Commissioner Chilton talks about what he calls the massive passive. We also look at high-frequency traders. We look at externalities like floods and those type of things. So I don't know what a normal year is anymore, but we will continue to do it. David and his colleagues in our Chicago office are just a wealth of information and will continue to work with any of you. I know a lot of folks have visited the offices and worked with them to get information, and the same holds true for our Kansas City regional office and our New York office as well. So any other questions or comments? Doug?
Mr. Chairman, David, I want to question about the weather issues that you indicated in the watershed. I live in that James River Valley area in South Dakota where the big red spot is, and I've been at a number of meetings in the last couple of months talking about our disaster issue there, and they're telling us this is the 4th year of a 10-year cycle of all this water, so don't expect things to change. Is that going to be a good thing for this convergence or a bad thing? I mean, Commissioner Dunn, you mentioned that what is normal anymore?
Well, like I said in the presentation, I think contracts, I think everyone, the commissioners would agree, and the economists at the CFTC would agree, a good contract works no matter what the supply and demand situation is. I think the problem with the contracts in the past is they've tended to work in average crop years, and when we've had tight supply and demand issues, they would tend to have the convergence. Whenever we've had oversupplies or big grain crops, we haven't seen convergence. We've seen the exact opposite. We've in fact seen divergence, and we approach first delivery day, and we're moving in the opposite direction. So that's clearly a disconnect between the futures and the cash. So to answer your question, I would say if a contract is designed correctly, it should work and converge no matter if we have floods, droughts, abundant supply, or virtually no supply. The cash and futures in a well-operating contract come together at the par points at first delivery day. And by come together, I'm not saying zero, because there's obviously differences, delivery costs involved. There's sometimes quality differentials between the cash and the futures. But we should definitely be seeing a coming together. We shouldn't be seeing this.
One other thing, Chairman, I want to also commend you for your past service, and I hope this gives you an opportunity to come to South Dakota and hunt pheasants a little more.
I will, Doug, but we do have some in Iowa. Let's go to our second panel now, if we could. And this is position limits and hedge exemptions, and this is two of the things that the advisory committee has already started talking about, and certainly I look for this to be a informative and spirited panel. Steve Sherrod and Dave Van Wagner. I don't have any, because we've got so much pushed into this meeting, I don't really have any breaks involved in here, so feel free to take a break anytime.
Hey, Doug, I've never been. Doug. Hey, Doug.
Doug, you
Good morning. Happy to be here again today to talk about proposed Dodd-Frank rulemaking. The Commission voted on and published for public comment a notice of proposed rulemaking to establish additional federal position limits and make a number of proposed changes to the way the position limit regime would be applied. We received about 12,000 comment letters, so we're busy with a staff currently of about 15 people trying to work to summarize those comment letters. Before the Commission can go to the next step, implementing position limits by a vote of the Commission, the staff needs to prepare the summary of the comment letters, and then we need to address and recommend approaches for the commissions to publish in a final rulemaking. So that's a somewhat involved process. We hope to be complete with a summary of comments by the end of this month. We certainly have a lot of people working very diligently on that process. The proposal that we have, I want to contrast it for just a moment to the position accountability regime that exists in some of the exchanges. And what we're proposing basically are bright lines, position limits that would be applied and that speculators would not be able to increase their positions above those levels. In the position accountability regime, the exchange needs a hook, if you will, reach to the non-members of the exchange. At the CFTC, our hook is when a trader becomes reportable. So we have reportable positions, and that gives us an ability to ask through a special call for additional information from a trader. At the exchange, once they have a hook under position accountability, they too can ask for additional information on request of the exchange. In the current proposed rulemaking, we have something called position visibility. That essentially is an automatic special call once a trader's position reaches a certain size. At the exchanges, the last part of position accountability is a trader, once they've exceeded or reached the level of position accountability, they've given the automatic consent to the exchange upon order of the exchange to stand still or actually to reduce the position. At the CFTC, for us to use a similar authority, we would need to declare an emergency. So that's the first difference between what we proposed, a bright line test, and a position accountability regime. The proposal applies to 28 different core reference contracts. The current futures limits only apply to 9 enumerated contracts, and they're not aggregated. In this proposal, we would aggregate across futures, foreign boards of trades that offer linked contracts to the U.S. referenced core contract, where those foreign boards of trade have direct access to U.S. persons. And we would also include economically equivalent swaps. So the limits in the proposal would apply across a broad range of contracts, whether they're traded on a board of trade, whether they're traded on a swap execution facility, or executed over the counter. We have a number then of aggregation provisions that apply to the different position limits. And this gets a bit complicated in the proposal, but much as we currently have in the federal limits for grains, there's a spot month limit, there's an individual month limit, and then there's an all months combined limit for each of these contracts. In a couple minutes, I'll go over some examples, and we'll illustrate how these individual month and all months limits would work. And then finally, there are aggregation provisions by owner or controller that are tighter in the proposal than what currently exists in the Part 150 regulations. So let's look quickly at the way the all months limits would work in the energy area, and then I'll look at an example of a few grain contracts. For the all months limits, much as we for a number of years have provided guidance to the exchanges on acceptable practices for complying with core principles, we use a formula approach, and that formula is based upon open interest. It's 10% of the first 25,000 contracts of open interest, and then 2.5% thereafter. So to get open interest, we need to look at what's the open interest in the core reference contract that trades on the designated contract market. In the example of crude oil, it's what trades on NYMEX in a physical delivery contract. But there are also cash settle contracts that trade on exchanges, and there are swaps that settle to those cash settle contracts. So we need to get more information about open interest to set a level for all of the economically equivalent contracts. What I can do by way of illustration is show what's the open interest in the main contract. In crude oil, for example, it's about 3 million contracts. For the whole group of contracts that feed into the crude oil contract, it's a little more than 4.7 million contracts. For the proposal that we have, much as we're thinking about a time period of an annual adjustment, we would use the month-end open interest for each of the 12 months and then average that. So for 2010, in crude oil, it was about 4.2 million contracts, just in the contracts that we can currently see, not including the swaps. Applying our formula then, we would come up with a limit of about 108,000 contracts in crude oil. So that's the way the math works. And let's look at some of the contracts traded on the Chicago Board of Trade: corn, soybeans, and wheat. The current levels of open interest are high. The open interest in the agricultural contracts tends to be in a single main physical delivery contract that's traded on the exchange, and there aren't a lot of lookalike contracts. That's a difference between the agricultural contracts and the energy contracts, for example. The average open interest in 2010 was about 1.175 million or so contracts. It's a little higher now. But using that 2010 average open interest, we can look at what the levels of the limits would be under the proposal. And this is where we've provided some flexibility for how the Commission might move to a final rule. In the proposed rulemaking for corn, we've said the existing limit in Part 150 in all months combined is 22,000 contracts. The Chicago Board of Trade has petitioned the Commission to increase that using the formula, applying it to, I believe, the 2009 calendar year, and that formula would result in 33,000 contracts as an all months combined limit. If we look at the 2010 level of open interest, the average level of open interest, and apply the formula, then the all months combined limit would be 46,500 contracts. So there are a variety of opinions that have been expressed in the 12,000 comment letters on how we might proceed. I look forward to receiving your guidance on which of these possible paths the Commission should pursue. Right. I'm going to turn to David Van Wagner to talk a little bit about account aggregation.
Thanks. Yes, as part of the position limit rulemaking, the proposed reg would also establish requirements about how to aggregate positions under common ownership or control for purposes of determining what is a position that's going to be subject to position limits. Conceptually, the aggregation requirement is going to attribute to a particular trader all the positions in which that trader either has an ownership or equity interest of greater than 10% or controls trading by some power of attorney or otherwise. I should point out that this basic aggregation requirement is consistent with the way in which, or at least as a baseline, is consistent with the way that the Commission currently aggregates positions and our expectations with respect to DCMs or exchanges that have position limits. Where the position aggregation requirements start to vary from the current regs is when it comes essentially to the exemptions from position aggregation. The CFTC's proposal would withdraw the current, what's been come to known as the independent account controller exemption, and replace it with a series of more narrowly focused exemptions to achieve disaggregation. So essentially, Part 151, our position limit regime, sets out three basic grounds for disaggregation. The first area where disaggregation is going to be available would be for passive pool investors who have an interest between 10 and 25%, ownership investment interest of between 10 and 25% in a pool. Now keep in mind, otherwise, again, being over 10%, they would have otherwise presumptively had to aggregate their position with the pool's positions. Anyway, the basic requirement is that the investor in the pool doesn't supervise or control the pool's trading in any way. The pool operator has to have written procedures in place to prevent investors from gaining knowledge of the pool's trading strategies or positions. And also the pool operator is going to have to apply and receive disaggregation relief from us so that we will essentially evaluate the procedures that they have in place to ensure a Chinese wall around the information that they have. Again, this is only for that band of between 10 and 25% ownership interest. A second area of disaggregation potential is for FCMs with respect to discretionary accounts. FCMs who have customary trading programs where the FCM doesn't control the trading and maintains minimum kind of management or control over the trading decisions in the account, and they have to be independently made decisions from the other trading decisions that the FCM is making in its accounts. And then finally,
David, I'm sure everyone knows what an FCM is, but just for me, would you explain what it is and give me an example?
Well, an FCM is a futures commission merchant, and we're essentially talking about the largest investment banks, I guess, to simplify it. An example you want to name? Okay. And in any case, and then there's a last category of disaggregation. I guess it's actually an awkward mouthful. It's the owned non-financial entity category. So it's essentially it allows an entity to disaggregate the positions of a non-financial entity, generally a non-financial operating company, in which the investing entity owns a 10% or greater interest. So that the entity that is seeking an exemption is going to have to demonstrate that the non-financial entity the target of investment, is independently controlled and managed, and then the regs, our proposed regs, set out a list, and it's a non-exclusive list, but it's a list of basically sort of indicia of independence, and some of those areas are the entities have no knowledge of each other's trading decisions. The non-financial entity has written policies and procedures in place to preclude knowledge of its trading strategies and positions. And then the two entities, the investing entity and then the non-financial entity in which the investing entity has an ownership interest, have separate employees and risk management systems. I should say, I mean, obviously enough, these are the three basic categories of disaggregation, we'll say, or at least aggregation exemptions. One thing that sort of very philosophically is different from our current aggregation requirements, where the exemptions are essentially self-effectuating, and there's really no prior submission or notice to us or any sort of approval by the Commission. With each one of these exemptions, there's some level of vetting with the Commission prior to being able to obtain an exemption. So that's it, I guess, in a nutshell for a fairly technical area.
So I want to talk a little bit about the bona fide hedging exemption proposal. In the Dodd-Frank law, Congress directed the Commission to write a bona fide hedging definition, and they left out a word which has in the past allowed the Commission's regulation for bona fide hedging, that's 1.3Z, to have a third part of it. So 1.3Z3 allowed non-enumerated hedging exemptions, and those exemptions were granted under our Commission Regulation 1.47. For example, it allowed us to grant swap dealers risk management exemptions without regard to the characterization of the counterparty's positions. Congress narrowed bona fide hedging and directed the Commission to write a new definition. So in the proposal, there's a new definition for bona fide hedging. It provides that, in general, the transactions must represent a substitute for physical market transactions in the case of physical commodity futures contracts. The Commission can retain the existing provisions for financial contracts on things like interest rates and stock index futures, but for physical commodities, we can no longer allow a bona fide hedging exemption for any risk management activity. Instead, Congress narrowed that and said, to the extent a swap counterparty would have been bona fide if they had approached the futures markets directly, then the counterparty to that transaction can use futures and essentially step into the shoes of who would be their bona fide counterparty. And in that way, a swap dealer would be allowed to manage the risk that they acquire by providing risk management tools to bona fide hedgers using swap transactions. So that's a little bit of why the bona fide hedging definition changes. And would be, if I have a minute, Commissioner, I'd like to touch on basically a little bit of the information we currently obtain so that the members can give us an idea about what else we might need to obtain. Currently, we obtain information every day through the Commission's large trader reporting position. I mentioned earlier, that's our hook. Once a trader is reportable, the Futures Commission merchant that carries their account reports the position each and every day to the CFTC. We obtain a trade capture report from each of our exchanges that lists the transactions during the day by what they call accounts. So, for an example, an executing broker has an account in an electronic system that may have orders from many different customers, but at least we get a trade capture report that says these are the transactions that occurred for a particular executing broker within the executing broker's omnibus account. And then finally, we can get access to the orders that are input during the day And that's an enormous number of messages in these electronic systems, the bids and the offers. And currently, quite frankly, we don't have the resources to receive and process an order book on a day in and day out basis, but we can inquire on specific time periods and drill down and determine what's the nature of the orders that are being entered. Under the broader proposals under Dodd-Frank, and to facilitate both surveillance of the swaps markets and setting and enforcement of position limits, the Commission has a swaps position reporting rule that's out as a notice. The comment period is closed and the staff has summarized the comments, and the staff is busy trying to finalize a recommendation to present to the Commissioners, which essentially would create a large trader reporting system for swaps as reported to the Commission by swap dealers. Down the road, we'll get intraday transaction information from swap execution facilities, and down the road, we would get information from swap data repositories that would be comprehensive on commodity swaps. We would receive either a life cycle set of information from a swap data repository, or perhaps just a snapshot if it's an end-user exemption transaction. But those are some of the other rules that will help us increase the richness of the data set so that we can conduct surveillance in the full market for commodities, both in futures and in swaps. And would be happy to answer any questions.
I would open it up to the Ag Advisory Committee. Remind you that although we've already received over 12,000 comments on this particular subject matter, everything that you say here today will also be taken into account as part of the comments. So you're going to get yet another bite of the apple here. Also, because we are in the rulemaking process, if you would address your questions to the staff and not necessarily to the commissioners, because we can't give you that give and take as much as we might like to. So with that, I will open it up to the committee for
Mr. Chairman, I have a question regarding the bona fide hedge requirements. Maybe this might inform some questions as well. Steve, what impact will the change in the bona fide hedge rule have on the positions we see today? You mentioned in some of your earlier slides, this is what the open interest and the rules how that would play out. Does that include the changes in the bona fide hedge definition?
Interesting question. I have to think about it for a minute. There are a number of changes in the way that we would approach bona fide hedging. Much as David mentioned, there are a number of changes in the way we would approach aggregation. So for setting the position limits, we would use all open interest, regardless of whether a particular trader's position was speculative or bona fide hedging. In our existing large trader reporting system, the reporting system doesn't tell us whether a particular trader's position is hedging or speculative. It just tells us here are the number of contracts open at the close of trading. So under the existing rules in Part 150, we have traders, for example, that are holding positions relying upon a self-executing bona fide hedging exemption in wheat, for example. We have them file a monthly form that identifies the types of positions in the cash market that are being hedged, whether it's actual inventory of grain or a fixed price purchase or a fixed price sell contract. And that information comes in once a month from the commercials. In the proposal, we would increase the frequency of that collection. And so it would be an additional burden to report more frequently on the cash market positions that are being hedged. That proposal, I think about it in terms of a bona fide hedger in the range of the three different options that I laid out in the slide and the additional options that were asked in the questions about setting the level of the position limits. So a hedger if we retain the existing limits, would have an additional burden if, for example, the Commission were to adopt the formula approach and substantially increase the position limits from those that exist under Part 150, then a number of hedgers might no longer be over the limit and they would have no reporting requirement. Right? So I hesitate to give a simple answer because the proposed rule has a lot of flexibility about how the Commission might proceed.
The bona fide hedge changes are in the position limit proposal, correct? And they require a rulemaking to be effectuated?
The Congress directed the Commission in Dodd-Frank to write a rule. So the existing bona fide hedging definition in 1.3Z is in effect, 1.3Z3. Would be the 1.3Z3 would be the part of the existing definition that would go away for physical commodities. And that's the one that allows us to have a bona fide hedge if it doesn't represent a transaction to be made in the physical marketing channel, but is more of a intermediary's risk management, trying to get flat on their exposure as they provide liquidity to both speculators and hedgers in perhaps the swap or over-the-counter markets.
On this same subject, could you walk us through how the reporting requirements might change for a swap dealer who currently qualifies under 1.3Z3? Under the new definition, how would they report with regard to that look-through?
So a swap dealer currently that has applied under 1.47 has indicated their needs for risk management, and the staff under that regulation gets 30 days to review it if it's an initial application, or 10 days if it's a change. And the swap dealer then would need to keep records under the current provisions. The additional provisions, the swap dealer needs to keep records about the representations of their counterparties that have said they are bona fide. And only those counterparties who are bona fide will sort of count in this risk management regime. So, for example, if a swap dealer has 100 contracts equivalent on the long side as their exposure, because there is a grain elevator that wanted to short 100 contracts equivalent in a swap, then the swap dealer, to the extent they have that 100 contract long position with that bona fide counterparty, can approach the futures markets and go short 100 and rely upon a bona fide hedging exemption. If that counterparty were a speculator, then the swap dealer cannot exceed the limit based on that speculator as a counterparty. So they will have to identify in their books and records the representations of their swap counterparties at the times the swaps are entered into, not on an ongoing basis, but at the times the swaps are entered into. And then the swap dealer would need to make that available to us for inspection if we wanted to review the details of their counterparties.
Okay, so they don't report that to us. They're just required to keep it.
They wouldn't report the details, no, unless we ask for it. So there's no registration requirement, if you will. The counterparty that's the bona fide hedger to the swap transaction doesn't have to file kind of a registration statement or get a registration number or anything on that side.
With that, we will now open it up to the committee. Roger?
I like that approach. I want to make one additional small comment about cash-settled contracts. There are some cash-settled contracts now that have scaled-down requirements on the position limits, which have no purpose, no point And I'd like to make sure that all those things be considered as you're developing individual position limits, that you not put one-size-fits-all things in where they don't fit. And scale-down requirements for cash-settled contracts is kind of pointless. And actually, as to quote Mayor Daley, it doesn't create disorder; it preserves disorder. So, thank you.
Todd.
A couple things, and I'll address first the bona fide hedge exemption. We actually told Congress we would have preferred if they left it with CFTC to make that determination. We think you all have done a good job over the years. But having said that, we do like the change in the definition that came out of the legislation. We like the fact that a swap dealer will only qualify for a hedge exemption to the extent that the counterparty otherwise would be a bona fide hedger. We think that the current risk management exemption basically has been an open back door to futures markets for in an unlimited fashion for swap dealers and their counterparties. In many cases, those were investors, funds, the massive passives. We think it's appropriate to put the brakes on just a little bit, and that it's a reasonable limitation. I think that will aid in performance of some of the enumerated ag contracts that have had some challenges with convergence in recent years. In terms of the position limits, in our comment letter to the Commission, we've supported retaining the legacy limits that y'all have proposed. We think the current limits are appropriate for the enumerated ag commodities. There are a lot of moving parts right now with Dodd-Frank implementation, with changes to contracts in Chicago and Kansas City. We think it would be prudent to let those changes take effect. Let's get the lay of the land and see how that all shakes out before we look at increasing position limits, at least on the enumerated ag commodities. And again, we think that will help in performance of particularly the wheat contracts where we've had some challenges.
Thank you, Todd. Others? Hayden?
Stephen, Dave, terrific presentation. Just a clarification. It's been our contention that the index funds has caused a dramatic increase in volatility, especially in the smaller ag markets, specifically the wheat contracts. So while I didn't hear exactly you say index funds, where do they fall in your bona fide hedging definition? And then will you also be looking at lifting those hedge exemptions or denying those hedge exemptions that have been granted in the past?
So the first question is an index fund a bona fide hedger? And the answer is no. So an index fund would be treated as a speculator. And whether they approach the futures markets directly or were opposite a swap dealer, in neither case would there be a bona fide that would pass to anyone. They would live within the speculative position limits.
And then the exemptions that have been granted in the past, would those be lifted as well?
In terms of the swap dealers that have been granted an exemption under 1.47, the general approach that I think we should recommend to the Commission, and I think it makes a bit of sense. The swap dealers have generally very large, some of them do, very large books of business. There are long side exposure and short side exposure, and the terms of the swaps may not match, and they hedge or manage the risk under the existing regulations by plugging that imbalance with futures contracts. So I think the way it makes sense to phase out of the existing 1.47 exemptions is to grandfather the existing swaps, and as those swaps age off the books, they would not count anymore in their need for risk management. They would not transfer over to bona fide hedging. So if, for example, a swap dealer had a long exposure on a swaps that would last 2 years, they could continue to manage that risk with short futures for 2 years. Once that existing book of business rolls off, the swap dealer would be under the new provisions and would no longer be able to use that risk management provision. With the size of the positions that are on in the swaps markets, I think it would be disruptive to say to someone with a very large futures position that is managing risk that you need to get out and you need to somehow negotiate your way out of lots of swaps if you want to reduce your risk. So I think that's the only kind of viable way to proceed without disrupting the existing book of business.
Mr. Chairman? Mr. Chairman?
I'm sorry, with respect to...
Bart? Are you...
I can wait for a moment, Mike.
Okay.
No. I'm sorry about that, Commissioner Chilton. With respect to maintaining the legacy limits, which, just for everybody's information, were set back in 2005 based on 2004 open interest data, these markets have seen and the entire futures markets have seen a tremendous increase in volume. And I know that it has been the contention of some of those who submitted comments that some of this is, in fact, fictitious volume that has come about through as some have called them, the massive passives. The fact is, though, that this is as most of the, I believe, arguments against the massive passives are simply anecdotal. When anybody actually looks at the facts, and this has been done routinely by many academics and professional economists, you can very easily discern, for instance, if you look at the COT data, the fact is that commercial short open interest has increased in the ag markets anywhere from 1.5 to 2.5 times more rapidly than speculative long open interest. So the fact is that long interest is meeting a growing and robust demand from commercial shorts, and I think those who have been in these markets for a very long period can remember a time when there was insufficient long speculative liquidity, and that commercial hedgers had to sort of go begging to find liquidity. So we CMC believes that not only that the limit should be set using the same formula that's been proposed, I believe, quite wisely for the other markets, that being the open interest formula, and should always rely on the previous years, and it should be done systematically. I think that the process of increasing limits should be reformed, and it should not be a petition process, so that there's some level of consistency and predictability to these markets. Therefore, I don't think that the ag should be in any way, or the so-called non-exempt market should be in any way differentiated from the other markets, and that this should be a reliable process. Further, also keep in mind that if we were to keep the legacy limits, we are now introducing an entire new player into these under these limits, and those are the swaps. And there are those who claim that there is not huge agricultural interest in the swap markets, but I think that the fact is that a lot of the index funds do have holdings and have been providing, I think, very useful long speculative liquidity to commercial hedgers, and that will now be brought under limits. So the fact is that a large amount of open interest will now be that was heretofore relied on the hedge exemption and was not under limits will now be brought under new limits. And I think that the open interest formula is a very rational, reasonable way, and again should be consistently applied across markets, and that the evidence or the hard facts bear this out. Thank you.
Thank you, Jason. Bart, you had a question?
Yeah, I was going to follow up with Steve on the previous question, although since that was talked about there, I'll just say very briefly, I actually agree that we need to update these legacy limits. I disagree with about everything else you just said with regard to massive passives. Here's what I know. There are so many different economists who say different things on this. And so when you say look at the facts, it's whose facts you want to look at. If you want to look at the ones that say the massive passives are having an impact, go to CFTC.gov, go to my speeches and testimony. I put about 10 different sites on there in some remarks I gave to FIA. But you can find them on your side, too. They're all over the map. Nobody, I think, is suggesting that we don't need speculators and that they're not important to these markets, and nobody's saying that massive passives are bad. It's just whether or not they're having an unintended impact on the market, and we should put some legitimate sideboards. Nobody's talking about getting them out of the markets. But my question, Mr. Sherrod, Steve, was about the hedge exemptions. And how would you recommend to the Commission that we define who has an underlying interest in the physical commodity? If there's a swaps dealer who has some small interest in, I don't know, home heating oil or something, would they be able to qualify, and I know this is theoretical, under the exemption? I mean, one of the concerns I have is that, the exchanges have a view that they want trading. I understand that. It's a business. They want volume. But from our perspective, it gets to the point where, when Dave was talking earlier about the financialization of some of the commodities, and that's my phraseology, but that some of the financial players get in and are using these markets as whatever, a hedge against the dollar, or some other hedging strategy that's beyond what has been done perhaps in the past. So how would we define that? How would you recommend to the Commission, Steve, that we look at the specifics of a bona fide hedger? Do they have to have some quantification of an underlying interest in the physical commodity?
So it's a two-part answer. The first part is for decades the Commission has recognized as bona fide hedging anyone holding cash market positions and anyone that has entered into fixed price purchase and fixed price sale contracts. And under the current regime, that's an automatic recognition. You don't need to file. You don't need to pre-approve with any of the Commission staff that you're holding cash inventories. You don't need to pre-approve that your fixed price purchase or sales contracts are okay. And under our existing definition in 1.3Z, if you're cross-hedging, you don't have to file that either. That is, if your expected price fluctuations in the cash commodity that you hold are related to the price fluctuations in the futures that you will use to hedge them, that's a provision that's currently in our 1.3Z bona fide hedging definition. There are certain types of positions that need pre-approval under the current rules and also under the proposed rules, and those would be anticipated transactions. So if, for example, a producer of a product uses as an input a physical commodity, and they have anticipated needs for the next year, under our current rules, we require that anticipatory hedger to file their annual needs over the last 3 years and to project their needs over the next year, and then the staff would review their information and approve the anticipatory hedge exemption. There's a similar provision in this proposal, and to go back to the example the hypothetical that you posed, if a swap dealer in fact had a heating oil business in an affiliate, the heating oil business, to the extent they're buying heating oil or they're engaged in fixed price purchase or sales contracts, they're a bona fide hedger. Just because someone is engaged in speculation doesn't mean they can't get the bona fide hedging. And that goes back to the data difficulties that we currently have. So someone that's both engaged in speculation and hedging, we get the positions every day, and we have an interest in having that hedger, to the extent they're over the limits, provide us additional information about the extent of their actual bona fide hedging needs, whether it's cash or forward fixed price contracts. So I hope that's responsive,
Yeah.
Commissioner Chilton.
Yes, thank you, and sorry to interrupt. I was just following on the other question. Thank you, Steve.
Other members of the Jordan?
Two things. One, my initial reaction to your grandfathering in would be very positive. I think it's a good idea and a way to handle that. But secondly, going sort of the massive passive thing, I know y'all have heard a lot about how we feel about massive passives and what happened in cotton in 2008 and how it sort of laid waste to the industry. And the flip side, we're facing a liquidity crisis in cotton. We're looking at increased consumption, increased production, and decreasing volumes in a horribly illiquid market. Yesterday, I tried to hedge 1,000 bales of cotton, coincidentally not the same I was talking about earlier, and it took a 1% move in the market for me to execute 10 contracts that in the cover month. That's just, I don't know, you want to unacceptable, ridiculous, whatever. We would welcome the liquidity the massive passives provide. But the only tools, and we feel like the tools are almost there or potentially there, and that would be surveillance, enforcement, and transparency. In 2008, if we could have seen the open interest, if we knew anything about the open interest, it would have been an entirely different situation. But unfortunately now we are in a situation where we know nothing about the open interest. And with the new phenomenon of exchange for swap, the EFS, again, we're willing to participate and play as commercial hedgers with that. We welcome the liquidity at this point. It's the devil we know, the massive passives, the ETFs. But we just need we need confidence that, one, there's transparency. We need the transparency to know something of the open interest. But we also need confidence that there's enforcement and surveillance. It broke my heart to see on the Wall Street Journal a few months ago that the $16 million required for a surveillance program was going to be unavailable, because we felt like as merchants that was probably the most valuable tool that the CFTC was in the process of offering us so we could know more about the security of our markets.
Continue along this side. Any other comments or questions?
Over here, Mr. Chairman. Steve, you mentioned omnibus accounts. The FCM that's carrying the omnibus accounts, do you have access? Can you see? Is there transparency where you can see the breakdown of what the FCM is carrying on those omnibus accounts?
Right, and so the breakdown is in two different ways. The first breakdown is the FCM reports every day the end-of-the-day positions for reportable traders. So we can see at the FCM level the large positions that are reported each and every day. Where it's a little more difficult for us is the transactions that are completed. When the FCM uses a single account, an omnibus account, and executes orders, much as the 10 contracts for your firm and maybe contracts for many other firms through a single account in the trading system, then those are orders. And in order to look at the order level detail, that's a set of information that we have to get by inquiring to the FCM to find the identity of the individual order levels.
You will only do that if there's a cost. I mean, if you have a reason to do that. It isn't a random thing that you would do, right?
That's correct. That's correct. Now, a number of firms that approached electronic trading platforms directly, so they're direct market access participants, they have their own accounts. And then we know for those very large and very fast transaction accounts, we can get the identity of those accounts directly and see in the daily trade capture report what they've done each and every day. It's the smaller customers that execute through FCMs through orders that we can't see unless it's an inquiry back to the FCM.
Mr. Chairman, I apologize for being late earlier this morning. I just want to let you know, I want to commend you as well for all the good work you've done on this committee and on the commission generally. And I really want to commend all commissioners. I mean, I think with respect to agriculture, since it's the sort of the origin of the futures markets, I think all of us feel like, of course, the people in this room, around this table, of course, feel like agriculture is special. And we all understand at the same time the way these markets have grown, around that sort of core. And we appreciate the fact that everyone at the Commission, particularly the commissioners, go out of their way, I think, to acknowledge and recognize how these markets are still different and special in many respects. And I just want to acknowledge that, and thank you for it. And with regard to Dodd-Frank, and I do have a question, but with regard to Dodd-Frank, I just want to say, I want to commend everybody at the Commission, the commissioners and the staff, because Congress heaped a huge amount of work. I don't need to tell you, on the Commission in this regard. And since they've done that, I know you've had everybody around this table, everybody in the audience, people in the press, people in the industry, people at the other end of the street, all telling you should drive faster, you should go slower, you should take your foot off the accelerator, put it on the brake, put the car in reverse, and you have an unenviable job. And so I just want to, I know you're all working very hard, and you've been given some impossible deadlines.
I know you're going to want something now, Fred.
No, I have a pretty simple question, and that is with regard to position limits. I'm asking because I'm either ignorant or I have forgotten. Does the rule with the 12,000 comments include the position limits across the spectrum of commodities, not just agriculture, but also energies and everything else? And is there anything? And can you inform us at all as to what expected timing is when you might do a final rule, and then also whether it's your intention, if you can say, to do a single rule that covers all those commodities, or I know there's been a lot of people in other places suggesting maybe some should be early harvested as opposed to others. I'm just curious if you can comment on sort of that set of issues and timing.
So the good news for staff is the 12,000 comment letters cover all 28 physical commodities. So it's not 12,000 just on agriculture. But the bad news is before we can move forward, we, under the Administrative Procedures Act, need to consider each and every comment letter, summarize them, and then consider how we're going to respond to those comment letters. We are driving to try to finish that first step of reviewing and summarizing the comment letters by the end of this month in May. And then we have the difficult task of trying to formulate responses, which ideas that we want to try to incorporate, which ideas that we don't think we should incorporate, and formulate recommendations for the commissioners, and begin the process of discussing with the commissioners the different comment letters, the staff's views of the comment letters, and get the input from the commissioners. So how long that would take, I really can't forecast. The third part of the question is whether different pieces of the rule could be voted on separately. I think the answer legally, David, is yes. Whether the commissioners want to take that approach, again, I can't answer.
And Commissioner Dunn, if I don't know if I'm allowed to. Yes. Am I allowed to answer any part? There's another rule that's very related to this that I want to say we probably proposed in the fall. We didn't get 12,000 comments, but Steve could tell us, called large trader reporting. And that's so that we, the Commission, could be more informed, but ultimately the public could be more informed on data. And so I could maybe ask Steve Sherrod the same question. How many comments did we have and what sort of timing? Because that the large trader reporting might be more ripe in a sense because it was proposed earlier, fewer comments, and it's about just getting data.
So you're asking me a number of questions, and I don't remember the answer, but it's not thousands, it's more like dozens of comment letters on the swaps position reporting rulemaking. Staffs review the comments. We're ready to begin the process of briefing the commissioners on our recommendation, and then it would be up to you as the chair to schedule when it might be considered.
So I was just noting, so there's 51 proposals we've made. There's every bit of reason that you focused on other things like running your business and so forth. But this large trader reporting rule is something we might also be able to move in a more timely fashion and start to get data.
The amount of information over since my tenure here, and the Commission has tried to be more transparent with the data that we have, and the commitment of traders has evolved over time. I think at one time we were contemplating changing it, and one of the questions that we asked was, should we keep the commitment of trader report? And I think David said he got a reply that said, it's the only thing you guys do right. Why would you get rid of that? So, but all of that information has spawned many of those reports that Commissioner Chilton talked about. And there are reports that have been sent to us as part of the comment on position limits. And so if you want to find those on both sides of the issue, those are on the website under those comments. All right, let me recognize Christine from the CMC.
Excuse me, and sorry, Jason, I don't mean to take over the microphone, but I had a couple of questions that I wanted to get some clarification on. And the first one was on this anticipatory hedge exemption that you were talking about. Just so that I'm clear, that, however, would not apply to commercial merchandising firms. So those types of firms that take those types of positions, they would be classified as speculative, correct?
To the extent that a merchandiser would not have a fixed price purchase or sales contracts, that's correct. They would be speculative. That's consistent with the existing approach.
Okay. The other question that I had relates to the if you're a commercial firm, you're going to be required to track. And again, I apologize, this may be somewhat repetitive, but I just want to make sure I'm very clear on it. You are going to be required to trace your sale or purchase agreement in the cash market to your position in the futures market and report that on a daily basis, correct?
Not on a one-to-one basis. So a commercial firm that, for example, has an inventory of wheat, they'll report their total inventory of wheat for the day. To the extent they're over a position limit, they'll report that because they need to avail themselves of an exemption to the position limit. So to be over the position limit means you have to have a very large amount of wheat indeed, because these limit levels are rather large. So it's going to be a large commercial firm reporting on their current inventory position and, as well, if it's applicable, their fixed price purchase and sales contracts as a daily matter, right?
Okay. All right. Thank you.
Steve, is that only if somebody's actually over the number? I mean, so for the thousands of farmers that won't be anywhere near these numbers, they don't have any, they don't have to track anything, do they?
They have to track a lot of things, but none of those have to do with the futures market.
Yeah, but nothing to do with us.
Right.
Yeah, okay.
Other questions or comments from the committee?
Commissioner Dunn, I just have one more question. Just want to get, and I don't want to beat the drum here to death, but on the index funds, let's say a year ago, a pension fund decided to invest in a commodity fund, Goldman Sachs, just to name one, commodity fund. So, and they elect to stay in that commodity fund for a period of years. So how would they be phased out of this eventually if, you know, they're going to treat this like a asset class and they're going to stay in commodities as they broaden their portfolio or spread their risk out over their portfolio? How is that going to change, or is this structure going to change that?
So let me try to kind of parse through that. Two different answers depending upon whether the pension fund has entered into a swap with a swap dealer that has a risk management exemption currently. In that case, the swap dealer would be able to retain their hedge exemption until the swap expires. In the second case of a pension fund or other speculator investing in a commodity pool that invests or takes positions in futures contracts, the commodity pool would be a speculator, and they would be subject to the limits. So as their existing positions in futures expired, they would need to get down to whatever the applicable position limit was.
Jordan, can I ask you a question about the cotton market, just because we're here? You mentioned the lack of liquidity, or less liquid, certainly, than wheat and corn and so forth. Do you have a sense of why that is? I mean, of course, it's a smaller market, but beyond just being a smaller market than the oil markets or the wheat markets, why do you think it is?
It's a variety of concerns, and every time somebody says something, of course, I want to pipe in, but it's not my arena. But going back to the first presentation, the increase in volatility has probably led to an increase in anxiety, and I am sitting next to a banker, but banks, there's a lack of financing, there's a general lack of participation, especially by the merchandising and the cooperative community. And I don't want to drag Kevin unwillingly into this conversation, but because the marketplace has changed so dramatically since 2008, we have a new exchange, the ICE that we work with. It's no longer the old exchange that we owned and operated ourselves. So it's a different set of rules. It's more the anxiety, and I'm not criticizing the ICE. I think they've done a good job this year of managing a very volatile cotton market, but their rules, it's not a CFTC situation as much as it is an ICE situation. There's just a lot of anxiety about a merchant's ability to establish, or a co-op's ability to establish and maintain a hedge. We feel like the actual withdrawal of commercial hedgers is the primary lack of liquidity, and when you couple our non-participation, what you've seen is an increase in volatility because of the lack of liquidity. And, for example, I spoke with the guys in our representative office here. I was talking to Jim Newsom about it yesterday, about people that want to participate in cotton from a speculative standpoint within their limits, but don't because of the lack of liquidity. In other words, they can't establish and maintain positions because the market's so illiquid and reacts so volatile. So much in either direction. Honestly, I wake up every morning and recheck the market, and I know it's going to be 3 cents. It's going to move 3 cents. I just don't know which way or why. And again, the problem there is probably not fundamental. It's a lack of liquidity issue, but it's apprehension over participating based on, like I said, an unavailability of funds, who's participating, and what happened in March of 2008. For example, in March of 2008, we had about 110,000 bales in my firm and 807 short futures. Now I've got probably 60 short futures and about a 30,000 bale position. And it's all because of, again, the expense of hedging and apprehension over my ability to manage risk.
Mr. Chairman?
Yes.
Chairman? I wanted to ask Jordan a follow-up question on that. I don't have any data, but it seems to me, based upon the notices that we've been getting, that we probably had more limit ups and limit downs in cotton, certainly, than in recent years. And when I looked at the first part of the year, the end of January and the beginning of February, it was mainly limit ups then. And I think it was 14, it may be 13, but I think it was 14, 11 of those limit ups were occurring before trading even opened in New York. So it was the overnight markets. And my question, Jordan, is whether or not you think that overnight trading, where maybe it's the Chinese coming, and look, it's great to have people in our markets, but I'm just curious, when there's light liquidity in these overnight hours, whether or not even a relatively small trade occurring when there's not a lot of people trading can move the markets that way, and if that is a concern, some people have suggested that maybe the overnight hours be reduced to some extent. I'm just curious your thoughts on that.
My thoughts personally would be yes, that is an issue and a problem. We met last week here in Washington, I guess a week ago today, with the ICE, and the ICE, at our request, provided us with some very useful information regarding nighttime trading and when volumes were being done. And I don't have it with me, but about 60% of the volumes being done during our traditional hours, which is sort of the 10:30 Eastern to 2:30. they, we've had various proposals to stay open when the Chinese markets are open and close again. I'd say the American cotton shippers, as a policy, would like to probably see less trading hours, primarily not so much as a lifestyle issue, because my company we're not represented in Asia by futures traders, but most firms are, so managing that is not a problem. It's just to concentrate liquidity and create efficiency in the marketplace. And we don't all agree that that would solve that problem, but it's obviously common sense, in our opinion, would tell you that if more business was being done in less hours like it used to be, then we probably would see a more efficient marketplace. And in those situations you mentioned this year, again, the ICE was very helpful. We went back and looked, and on a couple of those 14 occasions you mentioned, it was literally like 9 contracts that locked the market limit up. And we have a new provision now that when the options market, if the market's limit up, we can use derivatives or options to get out of our position. But if options are double limit up, then the market closes. And there was a 3-contract order that when the market was about 150 points from limit up on one particular day, a 3-contract order forced the market limit up and closed the market. Obviously, that makes our situation as commercial hedgers very difficult. So, long story short, you asked me what time it is, and I'm trying to explain how to make a watch. But, yes, we think that my opinion would be that less trading hours, or the trading hours are part of the problem. It's very thin at night, and less trading hours would be beneficial to the efficiency of the marketplace.
Thanks. Thank you.
Thank you very much, and I apologize also for being a little late. We had our annual...
Your excuse, Ryan.
We had our little World Sugar Dinner last night in New York, and I appreciate your staff being so helpful, keeping me filled in on what was going on. And I'm sorry I missed the surveillance portion. Was very interested in that. But I would like to bring up, it was actually very good because I was talking to all of our traders and everyone else last night that is in this. And our industry has become much more vertically integrated, so we're going all the way from the field, hedging on the futures market. People are more interested in what will be happening with the swaps market. And I would like to say where we've got the 11 world contract and the 16 domestic, we haven't had a lot of problems, but we're a lot smaller on the domestic side, obviously, much like cotton. So we are following this closely, and if there's going to be any changes between how the world market's regulated versus the domestic market, and there's probably been more glitches right now in the world market. Not many, but it is something I think our traders are watching, our people in charge of hedging we're paying attention to, and I hopefully plan on talking to ICE a little bit about those in the future. But do appreciate the workload and appreciate, I guess I've got great respect for what you are dealing with, much like Fred said, but we will try to stay as involved as possible as you go forward, because I think now with our end users trying to figure out who the bona fide hedgers are going to be, our companies are a little interested, or are interesting in the fact that they grow it at the beginning and then are selling it all the way through the end process. So we actually hedge probably a couple different ways depending on what the product is, if it's the raw sugar or the refined sugar at the very end. But appreciate your time. Thank you.
Commissioner Summers?
Thank you, Mr. Chairman. I have one other question with regard to the proposed limits, and the charts that we have in the packet are with regard to the all months. And I'm wondering if under our proposal, the changes, are we also proposing changes to spot month limit based on deliverable supply? So is deliverable supply now different than it was when we set, or the exchanges, either one, set spot month limits? And if we believe that spot month limits will go up at the same kind of levels that we're seeing here, the levels that are based on open interest?
So for the 28 commodities that we have, the spot month limits, the exchanges essentially set those limits. Under the proposal, once a year, the exchanges would provide data and a recommended spot month limit that the Commission, if we validate the exchange's information, The commission then would adopt that spot month limit for the following year as the outer bound. Each of the DCMs, the designated contract markets, could set a limit on their exchange at that level or lower. So if the exchange had a concern that the deliverable supply was shrinking during the year, they could set and administer a lower level. And that's currently the case in our Part 150 limits, where the exchange can petition to make them bigger, but they have the leeway to set a lower spot month limit. The formula that we proposed is generally consistent with the current guidance to the exchanges. We've certainly received comments on the specifics of how the deliverable supply should be estimated and how we should then take 25% of that to set the limit. There are some comments regarding whether, to the extent supplies that are in storage that are subject to long-term contracts should be considered part of the deliverable supply. So the staff is reviewing those comments, and we're going to try to make a good recommendation to you as a commissioner.
Thank you.
Jordan, I want to tell you that the comments you made about the risk and exposure and the lack of liquidity, when we were sold the bill of goods on overnight trading, we needed to be able to trade the crop reports before the Japanese. We needed to have access to trading the news and the liquidity. This was all supposed to help us. And even the NGFA, we supported these things. But in the end, I've come to the conclusion that it really doesn't work in the best interest of the people around this table who we represent, because it helps the speculation, it helps the volume, but it really doesn't help the user. I don't know, Todd, would you say, we supported, when I was at Cargill, we supported all these concepts because it was supposed to help. And in helping us as commercials, it was also supposed to help the farmer and the users and the cooperatives in that extension piece. But somehow, it creates the revenue for the exchanges and the FCMs, but it really isn't serving us, I don't think, as users. And I think if you polled everyone that represents, we wouldn't be advocates for overnight trading anymore. Can you, as the NGFA, you're our leading grain organization. We were advocates for this, just like we were advocates for the Staggers Act and deregulation. But somehow, this whole process changes, and the voice of the little guy in this process gets drowned out by the money-making opportunities we have for volume and electronic trading. We won't get rid of electronic trading because of the revenue it generates. But it isn't in the best. The farmer hasn't generated any more additional need for electronic trading. But the users in the commercial side of the business, the spec side of the business. I just think that's the issue. I think that the volatility is connected to the ability to trade more often, and the user doesn't, the small guy doesn't get a chance to use this process. I don't know.
Edgar, I would absolutely agree with you. We buy cotton during the day. Because cotton is now consumed in Asia, we sell cotton at night. We liked the idea initially, but unfortunately for my firm, or I think in general for the marketplace, it's probably been a failure. It has created volumes, but it also inevitably has created illiquidity and inefficiency in our marketplace to the degree to which ultimately it's the farmer who is impugning the most in the process. And oddly enough, about 2 months ago, actually it was in January, we started an initial series of conference calls with the ICE as the Cotton Committee, and interesting enough, they wanted to talk about expanding hours when one of the purposes of the call was contracting them.
Commissioner Dunn, it just seems like, this table, the issues that we'd address, we're at odds with the exchanges a lot of times. And it just seems like we're automatically, you ask us to come, we come here, but how do we implement the voice that the majority of us, the ideas that we have, we just somehow are at odds with the policies that, well, you know where I'm going with this, right?
I understand, Edgar.
Steve, can I ask a question on on slide 5, talked about trade capture reports, order book data. What's it going to take for us to develop an intraday surveillance system? How much time and how much cost? And then how does that relate to implementation of the standing up of swap data repositories?
You asked the impossible.
You had a throwaway line that we didn't have the resources, so I'm trying to figure out how much is it going to take?
So our head of technology, John Rogers, would probably have a better handle and estimate on it. John and his staff have been working for quite a while to try to scope out the storage devices that would be necessary to even store the high electronic message traffic from the order book. If we were to be able to store it, that's great, but we have to be able to get the data somehow. So that means a substantial transmission capacity to us. Once we obtain the data in the order book, we have the same problems with order book data that we have with the trade capture report that we, as staff, addressed with the Commission in the ownership, control, and reporting rulemaking to try to understand the codes, the short codes, the account codes that are used in the systems to be able to tie the activity back to particular traders or operator IDs, as the CME would style that, a tag 50 ID. And in the scope of that, I really don't have the numbers, but it's in the many millions of dollars for the technology capacity, both for transmission and storage, and it's likewise a significant number of staff to be able to manage that process, and a significant number of staff to have effective programs to extract from the great degree of data some usable information. So, don't have specifics for you.
Mr. Commissioner, I was going to add one more thing based on what Edgar said. Edgar, one thing I would say is about electronic trading. When we eliminated our open outcry and market making, and Mr. Chairman, we eliminated efficiency and liquidity in the process. And I might rue the day that I made this part of the public record, but at this point, and I don't know if it's through Dodd-Frank or not, we would probably welcome the entrance in a large way or a somewhat large way of algorithmic or high-volume traders. I know what happened in cocoa and sugar this year, and we don't like that. We had in our conversations with ICE last week, it seems like they have some circuit breaker ideas that might be effective. But we need the volume back. So as much as I said, I might hate saying it at this point, because the locals aren't coming back to the exchanges. We need locals, and if it comes in the form of algorithmic trading, we would probably welcome it, and we think farmers might realize a benefit as a result.
Doug stepped away, but one of the comments that they had sent in from the National Farmers Union and said they'd like us to address was that says the statement is the CFTC should hold emergency meetings as prescribed by Dodd-Frank early and often to ensure that position limits are effective and meaningful. Steve, are there plans to hold emergency meetings? What is the folks in DMO going to do? Is there a notification process to the Commission that you think we should be having meetings on this? How will that take effect?
So I don't think we meet. I turn to David here, but there are very specific statutory requirements for emergencies, and I don't think the conditions for emergencies are currently in play.
Right. Yeah, and we do have emergency authority under 887, but they are very specifically prescribed circumstances where time is of the essence, actually, and in certain ways it seems sort of odd to have a planned emergency meetings, but nonetheless, I mean, so I think the circumstances this person is probably talking about are potentially sort of structural problems, which I think are sort of meetings like this on an ongoing basis are more helpful towards. But 8A7 actions are, there's not actually a public meeting requirement around them, and there are very specific sort of prescribed conditions. But I can actually, I'm not, if there's an invocation of a Dodd-Frank provision, I'm going to have to take a look at that because I'm not particularly familiar with what might be referred to there.
If you would, I would appreciate that.
Sure
And
thing.
also, is there an opportunity for folks, be it the AAC or even their constituents that they represent, to request an emergency meeting from the Commission?
To request an emergency meeting? Well, there are certainly, not that I'm aware of, there's certainly procedures around petitioning us to force reg changes, which might force rule changes at the exchanges. There is certainly that. But forcing emergency actions, not that I'm aware of.
Thank you. If we could get the next panel to step up, please. If there are no more questions. And while the next panel is coming up, it's Mark Pfeiffer and Leanne Duffy. I'd ask the chairman to comment on a couple of things that we also got questions on. And this was from the CMC. They asked about the implementation timeline and sequence of rulemaking, and then international harmonization effort, and something that was brought up at this last panel. So if the chairman could quickly go over where we are on those two issues.
A lot to cover while Leanne and Mark just are at the table. But on implementation, the Dodd-Frank Act gives both the SEC and CFTC latitude on setting effective dates. It's not 100% latitude because it's, of course, has to be logical and so forth. We've had some public roundtables, and we've asked all of you and the broad public to comment on effective dates. And the staff put out, I guess it was about 3 or 4 Fridays ago, a list of concepts on how, I think there was 12 or 13 concepts in a 4-page document on thinking about implementation. But if we were successful over the course of the rest of 2011 finalizing rules, just as we finalize a rule in July of this year or September of this year or October of this year, does not mean that it would go effective in that order. The order of effective dates could be different. And in fact, I think you should all anticipate it will be. If we can, for instance, if after this discussion today, if we were able to move forward and finalize rules on the definition of agriculture commodity, that doesn't need to wait. The first concept in this 13 or 12 concepts was that it's lower cost to the public if we phase implementation, if we don't have sort of a big bang and everything has to be done on the same day of the same month, that it be phased. And some of the concepts that I would be terrific to get your feedback on in there, the staff concepts, was that the large infrastructures, meaning the clearinghouses, the trading facilities, what are called swap execution facilities and designated contract markets, and the data repositories, that they have to get their rule books in place before any market participants really have to have what's called transaction compliance. And though just about all of you and your members will be end users, I don't know that there's anybody here that, I know there's a little bit of this debate about farm co-ops, but let me just assume that you're all going to be end users for a moment and jump over that issue for 1 or 2 moments. So there's not a clearing requirement that would necessarily affect any of your members, but if the clearinghouses rules were finalized, if we were able to finalize them this summer or early in the fall, then there would be a period of time that the clearinghouses would have. We have to come together on how much time, but the clearinghouses would have some time before they'd have to comply with those new risk management standards of a clearinghouse. The staff concepts just threw out an example, and that's all it was. It said, could they possibly be open for business and have their new rule books by December 31st of this year, of 2011. That was in those concepts. But even if that were the case, the clearing mandate would follow afterwards. That the clearing mandate, which would actually affect financial entities, not your membership, but financial entities, would follow later. And that's sort of a concept. And so position limits is one that we just discussed. If we were able to finalize the large trader reporting rule, it would certainly be a hope of just the chairman, I can't speak for the commissioners, that we could finalize large trader reporting in the near term, in the summer, so that we can start collecting data. Obviously, if we have 12,000 comments on position limits, that might take a little while longer. But even in the proposed position limit rule, there was contemplating some phasing, that the position limit rule would be finalized, whether it's this summer or early in the fall, whenever that's finalized, there's phasing even contemplated in that position limit rule, that we need data, that data needs to come in. What we proposed, there had to be an order by the commission before the actual rule went into place. So that there's probably 20 more questions that could come on phasing, but we also opened a public comment file on implementation phasing. We opened that, I guess it was in April. That please send in thoughts. I think that that comment file, and it's just on our website, is open, and I know it will be open into June. On most of our rules, not all of them, but most of our rules, we also reopen the comment file for 30 days. That runs till June 3rd. As you see the whole mosaic, it would be really helpful to get feedback. I don't know, Commissioner Dunn, if that answers that first question. And the other one is international harmonization. The staff here and the commissioners have been working very well, and I think closely with regulators around the globe, and Commissioner Summers chairs it's another committee like this, but a Global Markets Advisory Committee, and Jackie Mesa gets all of us when she can to travel overseas. Where it stands is Japan moved actually before us, a month or so before, with a law last year. Europe is very close. The European Parliament is considering a law, and it might take that up and vote on it in the next few weeks. Canada already has its authority, so its regulators are starting to look at implementing this. There is a commitment amongst 20 nations, it was called the Group of 20, that was made in September of 2009 to move forward on derivatives regulation and have it in place by the end of 2012, to have it effective by the end of 2012. I can't speak for all 20 of those nations, but I would say I remain reasonably optimistic that Europe and the U.S. will be largely aligned. We're different cultures, different political systems. There will be differences. We will be able to recognize their regulation to the extent it's comparable and consistent. That doesn't mean it has to be identical, but it has to have some, consistency. That might be by topic area and so forth. So there's a lot of work still to be done, and it's not just by the CFTC. It's, of course, by the Treasury and the Federal Reserve and the SEC and others as well, trying to promote harmonization.
Mr. Chairman.
Thank you, Mr. Chairman.
Mr. Chairman, if I could just make one comment about phasing. I think it's CMC certainly believes it's a great idea, and obviously preferable to instituting everything at once. But I encourage you to keep in mind when you're phasing these in the implications of instituting, for instance, one part of a proposal that it may have on current market participants. For instance, doing away with the hedge exemption, the swap hedge exemption, before you raise limits in the ags would be, I think, extremely prejudicial to some of us. So I'm sure that you have that in mind, but we'd encourage you to keep an open dialogue with regard to those.
And I would encourage you and others to please note those for us. I mean, the one that you've raised is quite clear. At least I can't speak for other commissioners to me that they're sort of they have a mutuality. Capital and margin is an example. Again, not related to you, this group, but if when in doubt, please note it in a comment letter. Let us know so that we don't inadvertently miss that mutuality of something.
It was an elaborate sham to tease these things out of you, Mr. Chairman, so I could make my schedule for the rest of the summer. With that, if we'll turn to our third panel, and we're going to be running overtime. I apologize in advance. I ask my fellow commissioners to please check your schedule, see if you can stay. I am committed to be here as long as we can, and I apologize to members of the Ag Advisory Commission, but your questions have certainly warranted us being here, taking this extra time. So let's go with the swap dealer definition and end-user exemptions. Mark?
Good morning. We'll go quickly through our presentations and then get directly to your questions and comments. The rulemaking on the swap dealer definition was a joint rulemaking with the SEC. Was proposed in December. We got about 200 comments and meetings, and including many from the agricultural community. And as the chairman just said, we've extended the comment period. Like Steve said, we're reviewing the comments, and then we'll go to a final rulemaking when the commission's ready to do so. The definition of swap dealer largely follows the definition in the statute. It sets out four sort of ways of being a swap dealer: holding yourself out as a swap dealer, making a market, being commonly known as a swap dealer, or regularly entering into swaps as an ordinary course of business. In the rule proposal, we tried to think of looking at those factors and the comments from the public. What are some of the characteristics that distinguish swap dealers, such as that, and what the proposal said were ideas such as accommodating demand, facilitating other parties' interest in entering into swaps, proposing terms, engaging in the activities that are thought of for swap dealers. And this is obviously an area where we've had a lot of comment on whether these particularly are the right characteristics, how they should be interpreted, whether there are any others. So that's what we're doing now, reviewing those comments. The statute also has an exemption for a person who engages in a de minimis quantity of swap dealing. So in the proposal, we tried to think of what would be a level that one could say is de minimis, very small, an area that wouldn't require it. Somebody could engage in swap dealing but not register as a swap dealer. So we set out the four thresholds that you see on the slide. And this area, also we've had a lot of comment in this area about whether these are the right sort of factors to look at or where the numbers should be set. So we're going through those comments and analyzing them. There is also in the statute an exclusion for swaps that are in connection with originating a loan. And this is for insured depository institutions, banks. And generally in the proposal, we've said that this would apply to swaps that are connected to the financial terms of the loan. An interest rate swap connected to a loan would be a classic example. And in this area, we've had a lot of comments, and we're looking at this both from the perspective of the bank and the borrower and how this exclusion would affect the swap market overall. We're considering all of those factors. Generally, another thing that the proposal went into was, especially for the persons who are not explicitly holding themselves out as a swap dealer, we're trying to think of how do you identify what a swap dealer is. And what we propose is to look at a person and say, are you fulfilling the role of a swap dealer? Are you accommodating demand? Are you connecting people to the swap market? And again, this is an area where we've had a lot of comment, extensive meetings, and one of the real issues that we've had to face and deal with is that this is a definition that applies across all different types of swap markets, and we've had to sort of balance the idea of trying to provide guidance that's specific to a type of market versus having a rule that's fair and applies, has a level playing field across the board. The rule proposal also proposed some indicators of what it means to be commonly known as a swap dealer. Contacting people to solicit their interest in swaps, developing new types of swaps. These are the kind of things that we would be looking at, propose to look at to determine if somebody's commonly known as a swap dealer. And the next topic in the rule proposal was how you actually go about being designated. How would the process work? And generally what we proposed was that people would look at their own activities and decide whether they fall within the definition, and then they would register. And also important in the agriculture market, we recognize that many companies use swaps for a very wide variety of different purposes within the same company. And so only a part of their usage of swaps could be related to their swap dealing business. And then in that case, you would designate that part of your swap activities as being the dealer, and that part would register as the dealer. And your other swap activities would not be considered swap dealing. So there's a process we proposed for the company to come in and make an application to do that. And lastly, obviously, we note that the rule proposal did talk about how the rule on the swap dealer would interact with agricultural swaps, and in particular, we have a rule proposal out on swaps and agricultural commodities, and we asked and we've received comment on a variety of different topics on how the swap dealer definition should be applied in the agricultural market. As somebody said this morning, obviously the agricultural swap market is developed first in some ways and has unique aspects that aren't part of other swap markets. And as I said before, the real thing that we're looking at in terms of the comments is how do you balance wanting to provide specific guidance for specific areas and be sensitive to considerations of a part of the market without then having a balkanization of different rules for different markets that couldn't be applied fairly across the board. So those are the two interests that we're balancing.
Thank you, Mark. Leanne?
The Commission approved rulemaking for the end-user exception to mandatory clearing of swaps in December. The initial comment period closed in February, and the comment periods...
Leanne, could you move your mic closer, or could they ramp up the volume a little bit in there? Thank you.
The comment period closed in February, but it's been extended until June 3rd. We've received over 1,300 comments to date, and we continue to take meetings with commenters. The general clearing mandate in Dodd-Frank is Section 2H1, which makes it unlawful for any person to engage in a swap unless that person submits the swap for clearing to a derivatives clearing organization if such swap is required to be cleared. However, 2H7 provides the end-user clearing exception, which says that if one party to the swap is not a financial entity, is using the swap to hedge or mitigate commercial risk, and a notice is provided to either a swap data repository or the Commission regarding how it generally meets its financial obligations associated with entering into non-cleared swaps, it can avail itself of the end-user clearing exception. Credit risk generally is handled differently for cleared and non-cleared swaps. As proposed by the Commission, the end-user exception requires 10 disclosures about how a counterparty meets credit risk. An end-user must answer 5 questions about how it meets its financial obligations with respect to uncleared swaps. The questions are whether there is a written credit support agreement, whether it meets its financial obligations by pledging or segregating assets, whether there's a third-party guarantee, whether the end user relies on its own resources, or whether other means of meeting credit risk are involved. The end user must also identify itself. Who they are, whether they are a financial entity, whether they're a captive finance affiliate, and if there is an SEC filer involved, whether the entering into of the swap has been approved by an appropriate committee of the board or an equivalent institutional organization. There's also a 10th question, whether the swap is being used to hedge or mitigate commercial risk. Not all swaps are eligible for the end user exception. Only swaps used to hedge or mitigate commercial risk qualify. The Commission provided guidance on the definition. Swaps that are eligible for hedge accounting treatment or swaps that qualify for the hedge exemption from position limits or swaps that reduce risks relating to an end user's assets, liabilities, or services qualify as hedging or mitigating commercial risk. The Commission also provided guidance about which swaps would not qualify for the end user exception. Swaps used for speculation, investing, or trading don't qualify, and swaps used to hedge another swap, unless the first swap is used as a hedge, also don't qualify. The definition of hedging or mitigating commercial risk in the end user proposal is virtually the same as the definition proposed in connection with major swap participants. The Commission proposes to determine whether a swap hedges or mitigates commercial risk by analyzing the facts and circumstances at the time the swap is entered into and taking into account the person's overall hedging and risk mitigation strategies. In general, the proposed definition of hedging or mitigating commercial risk would not encompass any swap position that is held for a purpose that is in the nature of speculation, investing, or trading. Dodd-Frank directs the Commission to consider whether to exempt small banks, savings associations, or farm credit system institutions and credit unions from the definition of financial entity as used in the end user exception. Financial entities as defined in Dodd-Frank may not use the end user exception. The exemption being considered by the Commission would allow small financial institutions to elect to use the clearing exception. The Commission has requested comments from the public on the question of whether small financial institutions should be exempt, and staff is reviewing the comments received. Dodd-Frank requires notice to the Commission of how the end user generally meets its financial obligations associated with entering into non-cleared swaps. The proposed rule states that the notice is to be provided through a swap data repository if one is available. The Commission has proposed a check-the-box approach to providing notification. At the time a swap is executed, information regarding the methods used to mitigate counterparty credit risk or the financial obligation notice and other pertinent facts are provided to the swap data repository along with information about the swap itself that's provided to the SDR. The Commission's oversight and enforcement effort for end users will depend upon the information that is submitted this way to the SDR.
Commissioner Dunn asked if I could just, until he returns chair for a few moments, so why don't we open it up to questions for Mark and Leanne. Commissioner Maya.
I have a Leanne, on page 4, we have the 5 questions for end users. In the margin rule, the prudential regulator doesn't seem to be able to take non-cash collateral. Will we ask a question whether you're able to post non-cash collateral to another bank and then to get cash to to satisfy the prudential regulator? Is that nuance captured in these questions?
No.
All right. Thank you.
I just ask, on all of these, this is, if I remember, and this is just a proposal and the final rule could change, but this was a check-the-box sort of thing. Congress said that to be a commercial end user, you had to be non-financial, you had to be, secondly, hedging or mitigating risk, but thirdly, you have to say how you're managing your risk. Is that right?
Yes.
And so in the third one, it was just we have this form that you'd have to, the end users would sort of check the boxes.
Yes.
We don't plan to do more or less than that from our proposal. Is that right?
Well, we asked for comment on.
Oh yeah, they check the. We asked for comment, but I'm saying that if the proposal were the final, we're not asking for record reporting to us or record keeping to us. It's just a form, and they sort of the end users check the appropriate boxes on the form. Is that right?
Yes.
Okay.
CMC has several comments on this and would ask for some clarifications. I think they all fall under the general umbrella of what Christine mentioned before about the possibility that some of the hedge exemptions may be, in fact, as proposed, too narrow, going along with her initial comment about, and I think dissatisfaction with the fact that non-processors of food or food products would be deemed speculative and not be allowed to be to fall under the margin. Under the hedge exemption. But if you could just please clarify what you mean in the footnote 23 of the end user exemption. It's our understanding that the Commission will not deem swap positions used to hedge trading positions in the physical markets as hedging commercial risk. Is that correct?
Well, we've received comment on that concept from a lot of different people on what the distinction between hedging and then speculating and trading is. And we've received multiple comments on each side going into different industries. So we're going through those on what that distinction would be and how it would work. In practice, this applies both for the hedge exception and the major swap participant test. So there's a lot of different considerations. Couldn't characterize how that's going to come out.
Well, we certainly appreciate that. That's a very the distinction between hedging and speculating is a very difficult one to make, and I would just encourage that, or I think that many of the largest speculators, and this goes back to an earlier comment, just because there may be some small exposure to, say, heating oil in one part of the business, that may represent only a very small portion of the actual trading that's going on. To me, that seems that, and I understand it's a huge devotion of resources, but in order to make these particularly for CMC's membership, to ensure the hedging, that none of the Dodd-Frank really messes up the hedging ability, but either on the swap or the futures side, would encourage you to, as much as possible, draw those distinctions as clearly as possible, because to me it seems that the greater risk is in the very large speculators who are claiming hedge exemptions under the existing laws just because of very small commercial exposure, whereas, for instance, in the case that Christine brought up before, non-processors, where I think have a very viable argument that they are hedging commercial risk, would not be considered hedgers.
Mark, I believe it was in the end user proposed rule, there's a question asked of whether the exemption should apply to swaps just with the origination of a loan or at any time during the life of the loan. And our position was that it should apply at any time during the life of the loan because the swap would still be used for the same financial transaction. And I mention that just because I see it on page 6 of the presentation.
We definitely received that comment from different people.
Mark, this is American Bankers, and we have similar concerns about the lending exception and
Certainly in the agricultural context, it's very difficult to determine for the producers what their needs are going to be over the life of a multi-term loan. You look at things like crop rotation, you can't predict that 5 years in advance always. You can't predict the weather conditions. So these are types of things that are very important to us as we look at loans to agricultural producers.
Robbie?
Yes, Commissioner Dunn, and since it's the first time I've spoken today, I wanted to echo the sentiment expressed by others around this group about your service before the CFTC. I've only been at Farm Credit for a couple years, but I know your long-standing public service also included a time Farm Credit system, and thank you for that as well. And also, I guess what Fred indicated as well with respect to Dodd-Frank, regardless of your individual views, and they're varied. Appreciate all the commissioners' public service because it's been a lot of work, I know, by all the folks that are in this room and at this table, staff included. Thank you for having these items, the end user exception swap dealer definition being considered today. Those, I guess, we've filed extensive comment letters on both, and we'll let that largely stand. I did want to quickly note, however, about just our latest earnings came out the end of March, at least the first quarter, and as many of you know, the system continues to perform quite well. The overall notional value of our derivatives contracts are now down to about $41 billion. But the interesting thing is that you get down, the notional value sounds, rather spectacular, but when you get down to the exposure net of collateral, which is sort of the all-important sky is falling type situation, that's at $204 million, which if you take that to our total loan level, not total assets, but total loans now in the system are $177.5 billion. If you take that $204 million, I mean, that's in basis points, that's 11 or 12 basis points for the and again, that's just loan volume, not total assets are actually tens of billions higher than that. But when you start, we would argue, I guess, when you start talking about things like interconnectivity, systemic risk, we would at least hope the Commission would understand it's sort of an uphill climb to sort of, at least as far as the Farm Credit system is concerned, that there would be, implicating the system into that sort of risk structure, we think would be quite a reach. But at the end of the day, and again, this is laid out in our comment letters, if the system is treated, differently here, we do think there is going to be some meaningful impact as far as, increased lending costs to our farmer, rancher, rural America borrowers. So, again, I'll leave it at that, but thank you all for having this on the agenda today.
Thank you, Robbie. Others? Evan?
Thank you, Chairman Dunn. Appreciate you having the meeting today. I don't have a question. I guess I have a big question, but I won't ask that today. But I would like to pick up on some of the other comments in the room earlier today, and I heard a lot concerns about increased volatility, increased margin costs, and liquidity issues. And these would be three major reasons why our membership, the co-ops, have started using the over-the-counter market. For example, margin costs this year, if you have limit up in wheat and corn and soybeans in one day, you might be talking to your banker that night. However, co-ops have been able to alleviate some of those stresses by entering into swaps, and that's has freed up working capital. And by freeing up that working capital, they're allowed to continue to forward contract with farmers. This happened in 2008, and it's happening today. Without the ability to enter into the swaps, it would be more difficult to continue to enter into forward contracts, the local elevator, when prices are high and when farmers want to engage in those contracts. As you know, our concern has been being swept in as a swap dealer, and we're working through some of those issues. Another issue I looked at, we made some comments on the end user rule, And we did have a few questions, and it had to do, I'm going to assume that co-ops are end users and they enter into swaps with customers from time to time, and how end user to end user transactions will be handled as far as some of the data reporting, some of the financial reporting, and looking at those issues. I think it's going to take some time to work through all of this, even for end users, to figure out exactly what they need to do at the end of the day. So we appreciate your comments about phasing some of the rules in, and understanding that agriculture tends to be a high volume, low margin industry. Just keeping in mind, as all these rules are being layered on and all the reporting requirements, et cetera, are being put together, keeping in mind that at the end of the day, that's going to end up as a large aggregate cost, and it'll trickle on down to producers eventually. I want to recognize your staff and the commissioners for being very engaged with us in this process. We appreciate that. We appreciate commissioners' comments back in January highlighting some of our concerns, and we look forward to working with you and your staff moving forward as the act is implemented. Thank you.
Kevin, it strikes me that hearing from you and hearing from the representative of the three financial institutions that there is a lot that the industry needs to do on their own of getting prepared for this. And we would encourage you to be having those types of meetings and talking, with the financial institutions, if there are certain types of lines of credits or other guarantees that may be out there that you begin working with those. Mr. Chairman, I'm going to offer up your staff, the CFTC staff, to help attend those meetings as we go forward. It's all part of the implementation aspect of what kind of instruments are going to be needed out there, where are we going with that, and I think it would be prudent if we could give that type of assistance.
I think the staff always stands ready to take meetings with the public. I don't know, particularly as it relates to what we're trying to accomplish, but I also leave them sort of on their own if they have to deny a meeting because they can't travel somewhere and they got to get their work done on these 50 or so rules too. So hopefully you were chatting about here in Washington.
Our video conferences. Todd?
Just a quick comment. One of the things we like about Dodd-Frank is that we think it probably opens up some new opportunities for risk management tools, particularly to be offered to producers. The old ag trade option regime, which never worked, falls away. Those kinds of instruments will be easier for agribusiness firms to structure now to offer to producers. Under the swap dealer definition rulemaking, however, we have very similar concerns as you've heard from the co-ops. If a country elevator out in the middle of Kansas or out in the middle of Iowa is viewed as a swap dealer, defined as a swap dealer, those kinds of new tools are probably not going to be developed. I don't think any of our members, to the extent they can avoid it, wants to be a swap dealer, nor believes they're a swap dealer. So we would suggest that as the Commission continues in its rulemaking process, keep in mind the kind of business function that these agribusiness firms perform, not just co-ops, but also privately held companies. We've got about 1,000 members. About half of those are co-op, about half of those are private. Organized a little differently, but perform the same function in helping producers with their marketing and risk management plans. So we hope that there will be a common sense way of resolving the swap dealer definition issue.
Commissioner Dunn, thank you. And again, I'll join the chorus of thanking you for your service and everything you've done, and hope you've got your corn in. Thanks to the commissioners also. From an MPPC perspective, one thing I just put forth, and it relates to what was just talked about, but as we look at our membership, the potential, and I would just ask the commissioners as they deliberate this on this issue about the definition of a dealer, things in this order, that we see the greatest risk to from our membership of who's going to be impacted is a smaller producer. Our larger producers have the wherewithal, have the sophistication to deal with whatever. If you do get in a situation, as was just put forth either by a local co-op or local ag dealer, or in our case, we have co-ops that market hogs that really don't do a lot of this type of work, but if they get drawn into that definition, they'll step back. The ramification is the reason they do it is they're offering it to service to small producers that can't really justify the risk management or the cost of getting the risk management by getting into working with a normal dealer or broker or whatever. So I just ask that as we go through this that we deliberate and recognize that as this comes forward, there could be ramifications on this definition of the dealer that could have ramifications to the smaller producer looking for risk management also.
Okay, Neil, thank you.
Kevin and Todd and Neil all saved me a lot of time because I second everything they said. That pretty much summarizes where we stand on this. The first thing is the co-op. I want to emphasize that the co-op is the farmer and the farmer is the co-op. I really hope it's a no-brainer that the relationship between the co-op and their members shouldn't be considered a swap dealer relationship. And beyond that, the similar analogous relationships exist between small, all kinds of processors and farmers. They provide risk management opportunities because of direct relationships that are directly involved with marketing their milk. Even if a marketer of a farmer's product facilitates a swap with a third party, I would hope that there is a lot of leeway for that without chasing them off, without chasing off those folks by threatening to regulate them as swap dealers. Because I agree with all three of these gentlemen that kind of paperwork and regulation is going to chase off a lot of opportunities for the small farmers at the small scale that don't exist otherwise. And I also want to reiterate my appreciation for the Commission's work and especially for reopening the comment period now that we have a chance to see everything. That's very much appreciated. So thank you, and thank you for having this hearing, this meeting.
Any other?
I also want to recognize the Commission and thank you for providing this opportunity to talk. And I also would like to compliment your staff on their professionalism and responsiveness. When I have called with questions, I've been very impressed. So kudos to the staff. I wanted to also point out in the small, the end user, wanted to ask for clarification on the small bank exemption. And as I'm reading this, it says that you will include one in the final rule. You're anticipating including one, and just wanted to ask for clarification on that.
The Commission is directed in the statute to consider whether an exception is appropriate. We've received comments, and we are reviewing the comments.
Okay, so it's still at the consideration phase. There's been no decision on including it or not. Is that fair to say?
No, there hasn't been a decision yet.
Other questions or comments on this panel?
I have, Mark, I have two questions. And this is kind of a combination for both Mark and Leanne. Do we provide a clear guidance on end-user to end-user transactions? Do we say that these are clearly outside the swap dealer definition? Or how do we provide sufficient clarity on that? And then the second one, the chairman mentioned large trader. Are you working with the large trader team because it references swap dealer? Who is a swap dealer if we put out a large trader definition and reporting requirement, but have yet to do the swap dealer definition? How are you working with the teams, and how will all of these people deal with that going forward?
On the first question, I think we received a lot of comments, and these weren't simplistic, easy to read. They were very detailed comments, and I think there were a lot of things in the proposal that need to be clarified. On the point of what's the status of end user to end user trade, I don't think that was directly addressed in the proposal, because the proposal talks about who is a swap dealer and identifying swap dealers out of the many market participants. And I think one thing that could certainly be clarified is that if you're not pulled out and identified as a swap dealer or a major swap participant, then you're not in that status, and you're not covered by those requirements. I mean, that could certainly be more clear. And then in terms of the how will this rulemaking interact with the other teams, that's sort of exactly why this process takes some time of working through, of all the, like I said, of all the different, looking at it from all the different angles and making sure each one is covered. So these are all issues that we're considering of how the swap dealer definition will then interact with the other definitions.
Thank you.
Any other? Bart, do you have any questions?
No, thank you, Mr. Chairman.
If not, Mark, Leanne, thank you both. We appreciate that, and we, as usual, have saved the best to last. Ananda has been sitting there, but certainly the thing that I think is on a lot of people's mind, because I've heard it mentioned over and over again, and that's the margin aspect. So when you're ready, Mr. Director.
Thank you, Commissioner Dunn. I would ask somebody from OITS to pull up my slideshow. But while that's being done, just on a personal note, it is very gratifying to hear of all of the great accolades that have been provided to Commissioner Dunn, and I would echo those. I would also make a plea to Commissioner Dunn that he would consider staying with us as long as he can, not as long as he wants, but as long as he can, because I think, certainly speaking for the staff, we would benefit from the wisdom and the guidance that you've provided to the staff since you've come to the Commission.
Ananda, my wife, is watching this streaming out in Iowa, and you've just got on her bad list.
Did you say your wife is screaming out in Iowa?
Watching this streaming.
Oh, okay.
She may be screaming it.
So what I wanted to do today, members of the Commission and members of the committee, is to give you a summary of the proposed rulemaking that the Commission issued with respect to margin requirements for uncleared swaps. and this proposal was published in the Federal Register on Thursday, the 28th of April. It is page 23732 of volume 76 of the Federal Register. And the comment period ends on the 11th of July, 2011, to coincide with the end of the comment period for the Commission's proposed rule on capital requirements on swap dealers and major swap participants. So to get to the authority, the statute requires the Commission to impose both initial and variation margin requirements on all swaps that are not cleared by a derivatives clearing organization that's registered with the Commission. And this requirement is directed at those entities that are swap dealers and major swap participants for which there is not a prudential regulator. So, for example, the Commission's requirement, the Commission's eventual requirements will not apply to a bank holding company, for example. That has been addressed by a concurrent proposed rulemaking that all of the prudential regulators have also issued, and this is in accordance with the provisions of the Dodd-Frank Act. So if an entity is a swap dealer, but it is also prudentially regulated, then they are subject to the requirements of the prudential regulators. And for those who are not also prudentially regulated, they're subject to the requirements of the CFTC. As the proposed rulemaking indicates, we have strived to be as comparable to the requirements of the prudential regulators. It's just one little difference that, well, two differences that we made, and I'll highlight that. So, and also the other provision of the statute is that the Commission is directed to permit the use of non-cash collateral as it determines to be consistent with preserving the financial integrity of the markets trading swaps and also the stability of the U.S. financial system. So at the outset, let me indicate, because I'm sure this will be of interest to you, that this proposed rulemaking would not impose margin requirements on commercial end users, which have been defined under the proposed rules as non-financial entities. And as Chairman Gensler pointed out, let's work on the assumption that the entities that you represent will fall under this category. So if you fall under this category of commercial end users, then I will direct you to page 23736 of the Federal Register release. It's not here, but basically all you are required to do is to, all that the swap dealer and MSP will be required to do is to make sure that there are credit support arrangements between them and commercial end users. And basically the parties will be free to set initial and margin requirements and variation requirements as dictated by the credit support agreement. So basically you'd be required to have, the swap dealer and MSP would be required to have a credit support agreement or an arrangement to governing the swap relationship and a credit support arrangement, and margin requirements, if any, would be those that are dictated by the credit support arrangement. So let's go to the requirements. There will be requirements between swap dealers and MSPs, and in the proposed rulemaking, the Commission calls them covered swap entities. So a covered swap entity is a swap dealer, MSP, and other swap dealers and MSPs. And here the rules would require the payment and collection of both initial and variation margin for each transaction. With respect to trades between swap dealers or covered swap entities and financial entity end users, the rules would require that the swap dealer and MSP to collect but not pay initial and variation margin for each trade, subject to, in certain circumstances, to permissible thresholds. And then, as I pointed out, for trades between covered swap entities and non-financial entities, it would basically require the existence of a credit support arrangement with counterparties and for the counterparties to abide by those arrangements. Another important point, the proposal is that the rules would not apply retroactively. They would apply to uncleared swaps entered into after the effective date of the regulation. So whenever the Commission proposes for the final rule to be effective, these will apply to swaps entered after the effective date. Let's now go and talk about the calculation of initial margin. Initial margin will be calculated using a model that is approved by the Commission and is also used by a derivatives clearing organization, or DCO, that is registered with the Commission and clears a related swap, clears swaps, or is used by an entity that is subject to oversight by a prudential regulator. That model has been approved by the prudential regulator, or that's made available for licensing to any market participant. If no such model is available, then initial margin would be calculated by selecting a comparable cleared swap or futures contract and applying a multiplier that is set forth in the rule. And in all instances, all initial margin must cover a 99% of 10-day price moves. With respect to variation margin would be calculated to cover the current exposure arising from changes in the market value of the swap since the trade was executed or the previous time the position was marked to market. And the proposed rules previously proposed for swap dealers and major swap participants would require that documentation include an agreement on the methods, the procedures, the rules and inputs for determining the value of each swap at any time from the execution of the swap to the termination, maturity, or expiration of the swap. Now let's talk about the forms of margin. The covered swap entities would be required to accept only certain specified assets as initial or variation margin from other SDs or MSPs or from financial entities. And appropriate haircuts are specified in the proposed rule. I would direct you to page 23738 of the Federal Register release, and the forms of initial margin are specified there. And
Ananda, do you have the number of that Federal Register, or at least the date, so that people will be able to?
Yeah. So it is 76 FR 23732. So volume 76 of the Federal Register, starting on page, I guess it's 23,732. Right? And the date is the 28th of April. So the forms of initial margin appear starting on page 23738. Basically, it's cash denominated in U.S. dollars or the currency in which the payment obligation under the swap is required to be settled. And this cash has to be immediately available cash, which means in the United States it's got to be in a demand deposit account. Any obligation which is a direct obligation of or fully guaranteed as to principal and interest by the United States or an agency of the United States. And then any senior debt obligation of Fannie Mae, Freddie Mac, Farmer Mac, the Federal Agricultural Mortgage Corporation, or any obligation that is an insured obligation as that term is defined in the Farm Credit System back. So those are the limited forms of collateral, but we do ask questions as to whether we should expand the forms of collateral. And the schedule of haircuts appears on page 23739 of the Federal Register. Now let's talk about location of the collateral. Collateral for trades between covered swap entities and other covered swap entities would be required to be held at third-party custodians and cannot be rehypothecated. And covered swap entities will be required to offer non-covered swap entities the opportunity to have any initial margin segregated. So that is the end of my presentation. It is a broad summary. I would urge all parties who are interested to please look at the proposed rule as it appears in the Federal Register. And if you have any comments, please do submit your comments on or before the deadline, which is the 11th of July, 2011. Thank you.
Ananda, I know that you said this, but just to reconfirm. So for non-financial end users, they're not covered by our margin proposal as proposed.
That's correct.
And then secondly, the dealer is not required to have margin with them. The only thing is the two can negotiate, just as they do today, negotiate whatever their credit support arrangements are.
That's correct.
And thirdly, if they have whatever arrangements they do, we explicitly say that the dealer can, as the statute says, accept non-cash collateral.
Correct.
Of course, I mean, it's still subject to their negotiation.
Correct.
Questions, comments from the Ag Advisory Committee?
Thank you, Mike. I would also be remiss if I didn't say thanks to you, Mike, for your efforts here at CFTC and over your long history of serving American agriculture. So thank you. Just a couple of comments. One of the things that I've seen in a number of the proposed rules is the assertion that that over-the-counter swaps are inherently more risky than exchange-traded swaps, and I would simply say that I think that's painting with too broad of a brush, because a lot of the over-the-counter swaps that, for example, our banks use are simply customized based on the notational value of the loan, or they may not fit the model that the exchange is using. And from my understanding, the exchanges don't simply accept the low-risk swaps. They accept the they accept swaps based on the volume of business that they're doing. And so a lot of the swaps that some of the community banks would want to do with the midterm or mid-level swap dealers, they would like to be able to move to the exchange-traded platform, but they're unable to do so. So I just raise that as a point, because in the proposal where it says that that the capital could not be rehypothecated, from what we've been told, that could cause serious problems for the ability of community banks to use over-the-counter swaps, because it could force a number of the mid-level swap dealers out of business, and those are the ones that community banks use. So the community banks and their borrowers would therefore would not have a source to go to in order to engage in these over-the-counter customized swaps. So we're going to be commenting on that, but I just want to mention it because it's a serious concern that I think could affect our industry and our industry's ability to serve farmers and ranchers.
Thank you, Mark. Robbie?
Just a quick, process standpoint. Ananda, I appreciate your comments about the prudential regulator who also have sort of their own process, and we're working, Farm Credit Systems is sort of aiming I'm expecting we're going to have a comment letter, but I will say, as I sit here, we're trying to figure out whether or not we, either need to copy you all or answer your own sort of margin proposed rule, just from the standpoint that there may be situations where, given, how these contracts are entered into, that we may find ourselves in a situation where your rule is also relevant, but we're sort of trying to work through all that now. So.
Well, I would just say that we work very closely with all of the prudential regulators and the SEC throughout the process. Staff did throughout the process, as is directed by the statute, and so there were drafts sent back and forth between staff. Certainly, we would welcome comment letters, and I think it could, from a staff perspective, it could only be beneficial if you were directing a comment to one of the prudential regulators, if you felt you could copy us on it, because that could inform staff thinking and maybe the commission thinking as well.
Yeah, no, I would just say, obviously, the Farm Credit Administration is our prudential regulator, and so that's, with that in mind, we're focused in that direction. Thank you.
Robbie, I would say that, and we do this as best we can also on rules that the SEC has something similar. The staffs here are, as best they can, sort of in consultation with the other staffs and as commissioners. So we are talking to the Farm Credit, your regulator, as well as the bank regulators. So since Congress has asked us to the maximum extent practicable, I think it says, or maximum extent, it's some words like that, we're trying to stay consistent on these margin and capital rules. To the extent you have comments to them, you can feel free to go CC the CFTC, but even if you didn't, I think we would be looking at it.
Right. Yeah. Thank you. That's helpful.
Other? Diane?
Another process question. First of all, really appreciate you extending the timeline to dovetail with the capital proposal. It's very helpful. As we obviously are focused on the prudential regulator margin proposal, and then obviously incorporating in our analysis the CFTC's proposal. Wonder if you would give consideration, or probably will be asking to give consideration, to also have time to include in our analysis the SEC's anticipated proposal. Now, I know it's hard to say long in advance of the deadline, hey, we'd like some time, but I think it's become clear as we look at the prudential proposal, and obviously there are parts of it that nicely dovetail with one another. We're all anticipating also the SEC's proposal. So hard to comment in the abstract on that
Diana,
one.
I can't speak for the Commission, but I can speak for myself. I think we could wait and wait and wait, but we also had a real financial crisis in 2008, and we're supposed to try to move thoughtfully and also lower regulatory uncertainty. So the SEC will move forward on an important part of the market related to single-name credit default swaps and narrow-based credit default swaps and securities-based swaps and so forth. As Chairman Shapiro has pointed out, probably 5, 6, 7% of the swaps marketplace. So I don't know the answer to your question, but I say please also understand what we're trying to do is lower regulatory uncertainty, finish our rules over the course of 2011. I do think that the SEC has been doing an excellent job, but they have about twice the number of rules to do as we do. And hopefully they'll move forward close to this. But and if it were out in June or July, that would be helpful for all of us, but I can't speak for them.
And I just wanted to add, I appreciate what you're saying about how much the marketplace is under the CFTC's jurisdiction, but there will be at least some part of the marketplace that is the mixed swap that will be subject to joint or whatever you want to deem it jurisdiction. So that's something.
Do you think there will be many mixed swaps?
That's an excellent question.
Kevin?
Thank you. I have one question just because I have no idea what the answer is, and I think you can shed some light on this for me today. Some of our co-ops enter into commodity swaps with banks, and I believe those banks at some point have to take those trading desks and, I guess, push them out. Will those entities be under the capital and margin requirements under CFTC rules, or will they be under the other prudential regulators' rules?
If they're not subject to regulation by a prudential regulator and they're registered with the CFTC, then they'll be subject to the CFTC rules. Now, of course, if they're also, the other issue is whether they also have to register as a security-based swap dealer, and then in which case they'll be subject to the SEC's rules. But so the key is, are you subject to regulation by a prudential regulator?
Kevin, I think that you raise a very good point. I think that it will be some time, but the physical commodity dealing, whether it's energy dealing, agricultural dealing, as I understand, and as the lawyers have explained it to me, would ultimately have to be pushed out from the banks to an affiliate within their bank holding company. And thus, the capital margin would be under the CFTC for the commodity swaps. Anand is correct. If it were credit default swaps, it might be the SEC. So I think there would be some consistency, and it would come under the margin rules as we finalize them ultimately. If it's a non-bank affiliate of a bank holding company. Now, capital rules, of course, because it's part of a whole bank holding company, it's a little bit different. But does that answer your question?
I think so, and it's of interest because I believe the other proposal treats end users different than your proposal does.
Other question?
One question. Is there any spillover from uncleared swaps to listed contracts? Is there anything that's going to happen that might have impact on listed contracts margins?
I don't see it. I mean, we do make references to, you got to look, in terms of prescribed initial margin, you've got to make a reference to what a DCO does and so on. But are you concerned about the other way around?
Well, I just, now we have, I guess what I'm thinking about is now the exchanges are, most of them are, maybe all of them are for profit now.
Uh-huh.
And I'm just wondering how this is going to, how does this connect to the little guy, I guess, the smaller player who probably isn't, who may not use uncleared swaps. I just wonder about how that.
Well, usually, the exchanges set margin for the cleared products, and they're always trying to cover volatility with a certain amount of statistical confidence, and they send if they change it, they send it to us. We take a look at them, and I am sensitive to some of the comments that were expressed, which is that in times of volatility, it does become expensive to maintain a futures contract. On the flip side, we've got to be careful because we want to make sure that exchanges behave responsibly. So if there is a lot of volatility and people don't raise margins, then that triggers a question for us, like, why aren't you doing it? Why are you so comfortable not raising margins if you see extreme volatility? So I do see the tension there, if that's what you talked about. But I think, to my mind, I don't know whether, to me, it would seem that the margin for uncleared swaps may be influenced by what happens in the cleared world. In fact, it's sort of, one of the proposals sort of ties it in, that if you don't have a model, the alternate, what the Commission calls the alternative approach, is to make a reference to margin in the cleared environment and then add a multiplier. So it's the other way around.
The most significant thing I heard today was, when Jordan was given the example of what's happened to his industry, and as a student of the commodity market, the whole existence of why we're here was created for the purpose of the way the Board of Trade, all this thing was set up, was to service those guys, And now it almost seems like they're the insignificant piece of this. It's the size of which we've come to trade, the funds, the focus that we put on the money side of it, because that's where the money's generated now. And I just think about, like, when I came into the industry, it was like you wanted to work for a commercial. Those were the guys. And now it just seems like they're the insignificant pieces of this pie now.
Well, I think Commissioner Dunn had a good point when, I think Commissioner Dunn, you said that it was imperative for the exchanges and the users to have a frank dialogue, and staff could be a participant in that, because it seems to me that what I think you're suggesting is the market is not of use anymore. Is that what you're suggesting?
I just think there's an imbalance now. I mean, from where I was when I came in the industry and where we are now, and the positions and the attitudes I have about the market have completely changed now. I never would have thought I would have been an advocate for position limits, because I never thought the market would be that. I never thought anything would be larger than the Cargills and the ADMs and Bungies of the world. And I'm speaking about grain specifically. And they seem like the small potatoes in this whole process now. And it's just amazing the amount of money. When I came into the industry in the 70s, the amount of money, I never would have dreamed that we would have had this type of participation and the global aspect of it.
Well, further to some of what Edgar was saying, we do appreciate the opportunities this sort of presents, because we do need, in addition to liquidity and efficiency, all these different tools give, I think, us opportunities to manage risk. And I would agree with you wholeheartedly. As volatility goes up, margin requirements should go up. The clearinghouse has to remain financially viable, and that's why we like the idea of some of these margin ideas on swaps. And an additional comment, Edgar, just in case, I'd have to say what you're saying, you're not thinking it. It's basically fact. In a conference call we had with the ICE again in January, they told us we weren't their most important constituent, that the ETFs were, index guys.
And see, in my mind, that defeats the whole purpose of why we have a futures market.
I couldn't agree with you more.
Any other comments from the Ag Advisory Committee? How about from the commissioners? And I'll start with the chairman.
Well, I had a question, but before I say the question, what Jordan and Edgar just talked about is a challenge for those of us that serve on the commission. Markets since they were started, had hedgers and speculators meeting in a marketplace. If you wanted to lock in your price at harvest time, which is a lot of the reason why the futures market started, there was somebody on the other side that was often a speculator on the other side of that market even 100 years ago. But now, as Edgar says, that the ratio shifts, that in some of these markets, the vast majority of the market are financial participants rather than producer merchants. You know, what does that mean? We promote transparent, open, competitive markets. We are not a price-setting agency. It's about making sure the markets are open and competitive and free of fraud and manipulation, and there's integrity. But this discussion probably will go on for years, but any advice you have will be very helpful. I want to just ask a question about the agricultural commodity definition. It wasn't a rule that was, but just because we might move on that in the next month or two. And some of you, I think there was only 20 to 30 comment letters on it, but if there was anything, on anybody's mind, that we hear that. And also there was a rule that Congress said that they can't do agricultural swaps unless we do a rule saying that you can do agricultural swaps. And largely, I might have this a little off, but what we said is, yes, you can do agricultural swaps in accordance with the rest of Dodd-Frank. So those two, the definition of agricultural commodity and in essence, how agricultural swaps will be treated are two proposals that I don't want to assume anything, but if there was anything you want us to hear, it'd be great to hear.
Well, I'd just be echoing the CMC's comment letter that we believe that all swaps should be treated consistently and that there shouldn't be a distinction necessarily on ag swaps.
We would agree with that and felt that both of those proposals were well done.
Thank you, Todd. Any others? Any final comments, Mr. Chairman?
Just mostly to thank you again. I mean, I don't think you're going anywhere anytime soon. I'm sorry that your wonderful wife is watching me say this, but Brooke's going to, get me. But your leadership of this committee and the counsel that you've given all of us and continue to give us on the issues that are related to the core of our market, because we started as an agricultural, over in the Department of Agriculture in the 1930s, we started just overseeing grain markets, but though it is a smaller percentage of what we oversee, it is a big part of our culture and how we look at markets, and Mike brings that perspective, which has been terrific.
Jill, any final comments?
Just to say thank you to all the participants here today. I think that certainly your perspective on all of these issues is very helpful to us, so thank you.
Commissioner Dunn, I'd like to take a shot at you, but I guess I really can't. Everybody's been so complimentary, but
we can wait for that. We'll have more.
Yeah, well, I really do appreciate But I guess my question is, given the service that you've given and the time, who's going to replace you? What's going to happen to we could always come to you because we knew your background in agriculture. So who's replacing, where's the Ag Advisory Committee in all this process, and who's going to give that leadership now that you're leaving?
Edgar, that's up to the President and the members of the Senate on confirmation, and then whoever the chairman appoints as my successor on the Agricultural Advisory Committee. The official designee on here has actually we've already passed that mantle, and Jason Ghisarelli, who is on my staff, is now the official designee from the Commission on the Ag Advisory Committee. But my fellow commissioners are all going to be listening, and I do appreciate, Edgar, over the times that you and I have talked, and you've brought to me special concerns that you have from your constituents. So with that, Bart, do you have any comments?
Just briefly, Mike, I wanted to, not that the exchanges need to be defended, they've got enough lobbyists themselves to do a great job, but look, it's a balancing act for us to try to figure this stuff out, but that's our job. That's what we're supposed to do sort of 24/7, 365. ICE, for example, they're concerned about HFTs and about the speculative interest. They want to deal with that, but they've only got 10% of their market are HFTs. And, we have to remember these markets, the regulated futures exchanges, they worked very well in this economic calamity. We've got this big Dodd-Frank bill, but the main part of that is really dealing with OTC land. And Mark, you talked about the bankers and how swaps aren't dangerous, and certainly I'm not suggesting they are, but credit default swaps were pretty dangerous. They helped propel AIG down and others. So it's getting a hold of this new animal, the OTC land, for us, for folks who haven't dealt with it. And I think that's why some of the proposals that have been out there didn't hit the mark exactly. It was a learning curve for us. And that, when people see proposals originally, that scares some folks. But this iterative process that we're going through, not only in this meeting, but through the comment period, that's really what, how regulations are come up with. That's how they're devised. And so it's very helpful, and, it's our job to seek the balance. And I think we're going to do that. We may not do it exactly the time period that all of us would like. I want limits now. That doesn't look like it's going to happen. I'm disappointed. But I understand that we're going to have to get there on all of these things in due course. So I thank all the members, and thank Commissioner Dunn, Chairman Dunn, and thank Commissioner, my other colleagues, and particularly thank Chairman Gensler for his leadership on all these important issues and keeping the trains running as close to as possible, Gary, on time. Thank you.
Commissioner O'Malley.
Let me thank you for putting together a very high-value meeting. The staff presentations were excellent and tight. The comments were well thought out, and obviously had the benefit of reviewing our rules, and I found a lot of value in this. So this was a very worthwhile endeavor here and a great meeting. Thank you.
Well, thank you all. I was remiss in not recognizing my predecessor on the Ag Advisory Committee and Gary's predecessor as the chairman of the commission. And Jim, would you stand up so we can all recognize Jim Newsom? And I'm sure there were people who thought when Jim Newsom stepped down, well, gee, we're never going to find somebody to fill his boots on the Ag Advisory Committee. Someone will take my place. But it has been a real pleasure and honor to work with the Advisory Committee. Many of you I've known for years, some for decades. We've worked together, and I appreciate your counsel and your willingness to come here and give your perspective to the Commission. It does help us as we make our decisions to get your input. I appreciate it. But I really appreciate my fellow commissioners. This has been a delight for me to serve as the chair of the Ag Advisory Committee, simply because I've got such wonderful people to work with. And what makes them so good is their staff and the commission staff. So I thank everybody, and with that, we're adjourned.